the risks are rising. This risk of something deeper than a 10% drawdown, that is rising.
The markets will come to recognize that this volatility is here to stay.
You have to have some risk aversion in the portfolio.
As an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago, and none of us did.
There's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Tuesday following the biggest one-day loss so far this year. Equity futures just about stabilizing after getting hammered in yesterday's session. The sentiment shift has been absolutely wild, and the cuts to corporate guidance begin. Delta Airlines first out of the gate. Big declines this morning after slashing its outlook for the first quarter. The airline pointing to, quote, recent reduction in consumer and corporate confidence caused by increased macro uncertainty, driving softness in domestic demand. That stock is down. The other airlines are as well. The question we've got this morning, who's next?
And the question here is, how quickly is this moving? To your point, earlier this year, in January, Ed Bastian, the CEO of Delta, said the supply-demand balance is as good as I can ever recall it being as we look into 2025, saying they had visibility. And suddenly, something shifted dramatically, and they said, we really do believe this is a domestic issue. It's not just who's next. It's just how quickly this is moving and how much the sentiment data really is going to be the key driver.
And later this afternoon, President Trump will be sitting down with a number of executives, and he will get a grilling about what is going on in terms of why you have this uncertainty. When you look at what corporate executives are saying, when you look at some of the survey data, the write-in statements, people are concerned about the direction of travel when it comes to tariffs. Chuck Robbins, the Cisco CEO who leads the Business Roundtable, had this to say in January: we won't always agree, talking about the Trump administration, but I feel confident that we'll have an opportunity to have that discussion. Well, that dialogue, Jonathan, will happen tonight.
Coming into 2025, as you know, sentiment among corporate leaders was sky high, and we wanted to see that translate into better hiring, into better investment. Small business confidence rocketed higher. This morning, small business confidence drops to a 4-month low, and plans to expand move in the wrong direction.
And it's exactly the wrong mix. It goes back to this stagflationary light type of mix, because not only is confidence going down, but the share of firms in the NFIB Small Business Confidence survey say that they plan to raise prices. That level increased the most since April of 2021. So what you can see is price pressure increasing at the same time that they have less confidence that the customers are going to be spending as robustly. This is on the margins. This is fast moving. But right now, because it is so quickly moving, hard data is less important on some level than the soft data that indicates the speed and the direction.
If you're a CEO sitting down with the president today, your number one issue right now has got to be clarity. You just want clarity on policy. And at the moment, we're facing what looks like maximum uncertainty. At what point, as an investor, this is what you'd be asking, I think, as well at the same time, at what point do we pass peak, maximum policy uncertainty?
I wonder if Donald Trump sees this as maximum uncertainty. When he was in the interview over the weekend with Fox, he talked about how actually he's being very clear about his goals, and that his goals have been laid out in terms of how he wants to rearrange the U.S. economy. My question is, does he recognize the sort of in and out tariff strategy that he has and what the consequences could be on business? Or is this a feature, not a bug? And is he saying, this is part of what's going to happen in order to rearrange some of the structure?
Well, we're not at peak uncertainty yet, because we haven't even have the entire menu when it comes to tariffs. We're going to get that on April 2nd. We also have 25% on aluminum steel coming into play tomorrow. And guess what? Retaliatory measures already coming from Canada when it comes to Ontario and what they're putting on electricity coming into the United States. This story, this is just the beginning. It is not the end.
Equity futures this morning just about positive. We are bouncing back by just 0.25% on the S&P 500. Coming up later on in the program, Brian Levitt of Invesco following the worst day for the Nasdaq 100 since 2022. Rob Casey of Signum Global Advisors ahead of Trump's meeting with bank CEOs, and Alastair Pinder of HSBC after downgrading US equities. We begin this hour with stocks looking to recover after growth fears drove the S&P 500 closer to correction territory. Brian Levitt of Invesco writing, tariffs are likely to lead to a more volatile investment environment rather than result in a bear market for equities. I would not expect a broad decline in risk assets or a recession in the economy. Brian joins us now for more. Brian, good morning. Good to see you.
Nice to see you too.
Where does that more optimistic view come from? What underpins that?
So what underpins it is ultimately a belief that we will start to see a move towards greater clarity, but that gets called into question the longer that this persists. So my view in writing it was ultimately the administration will provide greater clarity around this. Look, tariffs result in less optimal outcomes, but as long as we know the rules of the game, businesses will get through it. And of the belief that, the Federal Reserve, given the recent inversion in the yield curve, will start to sound a more dovish signal. But the longer it takes for us to get there, we're at greater risk of these things happening.
When things like this do happen, and they happen often, we have these growth scares, you're waiting for that cathartic moment. Peter Chi of Academy said, this is the first day that feels like a real washout has been occurring. Mr. Krinsky over at BTIG, Jonathan saying, if you were hoping for an entry point, this is your chance. Have we had that cathartic moment yet?
I'm not sure we've had the full cathartic moment. I mean, I went back yesterday, though, and I looked. Yesterday was the 93rd worst day of the NASDAQ in 30 years. So let's put it into some perspective. I went back. I'm not the best at Excel. I'm almost 50 years old. But I brought up my Excel spreadsheet, and I looked at the other 92 worst days and said, well, what if I added money on each of those days? What if I withdrew money on each of those days? And obviously, you were better off adding money on each of those bad days, right? So I think most investors don't think that way. So you don't necessarily need the cathartic moment. I don't think we're there yet. I think there's more to go in terms of a bottoming process. But even if you're investing and you're halfway through a correction, historically, that's been quite good for investors.
More to go. What needs to happen for that cathartic moment? And then, frankly, for a steady climb upward? What kind of information do people need to see?
Well, we need clarity. I think Jonathan said the exact right word, which is we need policy clarity. And I go back to 2018, thinking about what was going on then when we were dealing with the U.S.-China trade war. So what ultimately led to a bottoming in the market? The United States and China got together and said, okay, 90-day truce. Well, that doesn't fully eliminate uncertainty, but 90-day truce. Federal Reserve came forward and said, all right, we're done raising rates. We may even be lowering rates in 2019. And that type of policy clarity is how you start to move forward. So long as we're in this environment where consumers don't know the rules, businesses don't know the rules, you're going to be challenged for a while.
Right now, the bulls on the street are basically coming out and telling us it doesn't really matter if we have ongoing policy uncertainty. On the fiscal side, as long as the Fed comes out and rescues markets, as long as they cut rates by enough, then you end up with a rally and a supported market. Do you agree?
Well, it can't hurt, but I think you're going to need it beyond just the Federal Reserve this time. You can't be making the cuts that you're making on the fiscal side and creating the uncertainty you have on the trade side and think that the Fed or Reserve alone, just bringing rates to neutral, can solve this. I mean, the reality is most Americans have fixed rate mortgages anyway. Most Americans didn't recognize the move up in rates. They're not necessarily going to feel it on the move down either. So you're going to need more than that. You're going to need trade and fiscal policy get to a place where we understand where it's going.
When it comes to trade, though, that uncertainty is why Donald Trump thinks he can have this negotiating power. How long do you think the market could sustain this uncertain period? Because it could be months.
Well, it could be months. I mean, we can, I don't know. So the word sustain, I mean, we can fall further from here, right? I mean, we're used to 5 to 10% corrections. They happen every year. Greater than 10 are less frequent, but they're almost always the result of policy uncertainty. And so the market could continue to feel pressure from it until you finally understand what the rules were going to be.
Do you sense there's a pain threshold within this Trump 2.0?
We certainly hope so.
Right.
You know, I mean, the idea of the Trump put is being called into question right now, but ultimately, I don't think this is an administration that wants to see the markets moving the way they are. Now, they may have an ideology around trade that they want to pursue, and they're not going to move away from it. But let's get with it. Let's figure out what the tariff rates are going to be, and let's move on.
In 2018, they tolerated much more than this, didn't they?
Yeah, 2018, we were down 20%.
Is that what you're looking for now?
It seems like you're moving towards that. I mean, right now the S&P's down 8.5%. I mean, we were down 8% when the Bank of Japan raised interest rates once last year. So this seems a little bit more challenged of an environment than that. Again, I come back to the fact, though, if you're an investor and you invest halfway through a downturn, you should be okay. So let's not try and get too cute with this, but it doesn't feel like the bottom is in yet.
Consumer discretionary is down 20% from the recent highs. led by Tesla, of course, but the airlines have started to participate. Delta this morning down by something like 11%. What do you do with consumer-exposed names? When you hear Ed Bastian, the Delta CEO, say things like mid-February, consumer, business, purchases, activity just started to stall. He says it's going to be transitory. Do you think it's going to be transitory?
I do think it'll be transitory because this was an economy that came in with fundamental strength. Right? The consumer, where household net worth was at all-time highs, where the unemployment rate was near all-time lows. So it's a consumer that's coming into this in good shape. It's a consumer that's not over-levered. It's an economy that's not over-levered. We were in a good backdrop. The consumer right now is tightening their belt a little bit because they don't know, if they work for the federal government, you're not sure what your employment picture is going to look like. If you're in the market, you're not entirely sure what your household net worth is going. So you tighten your belt a little bit, but it doesn't feel like a recessionary environment. Now, could you get there with a prolonged period of uncertainty? Sure, but when you look at the usual indicators on a path to a recession, big leverage, big excess, corporate bond spreads blowing out, none of that exists today. And until corporate spreads really start blowing out, I'm not ready to think of this as a much more meaningful downturn, a severe recession. It's just not what the picture is telling us right now.
Initially, a lot of Wall Street firms agreed with you, but the downgrades have started to pour in. We've seen it from HSBC. We've seen it from Goldman Sachs and JP Morgan. Citigroup coming out, downgrading the U.S. Equities to neutral and upgrading Chinese equities. Yeah. At what point would you agree with them and say that actually, at the very least, to quote Citigroup, U.S. exceptionalism is at least on pause?
Well, we're upgrading European equities as well. I mean, we've increased our exposure to European equities earlier this year. And why? It's not complicated. Leading indicators in Europe were climbing. The economic indices were surprising to the upside. The European Central Bank was easing. It was a better mix versus sentiment in the United States declining in a period where valuations were more heightened. So you're getting these cyclical bounces. I always say these markets, everyone's waiting for things to be good in Europe. No, markets move on better or worse. By the time you wait for good, it's already happened. The bigger question on Europe now is not just the cyclical bounce, is this something more structural? And with the investment that you're seeing, the borrowing that you're likely to see out of Germany, is this more structural? They have a chance. Now, can we get 27 countries to agree on it? We'll find out. But there is certainly a chance. And yeah, I mean, sometimes it's real simple. If you're easing policy, it's a better backdrop. If you're pursuing tighter policies, it's a worse backdrop, and it behooves investors to think about those parts of the world that are being more stimulative right now.
A Citi making the point that the better news will come from elsewhere over the next several months. It won't come from here.
What's interesting is that Citigroup thinks that better news is going to come from China, whereas HSBC thinks that better news is going to come from Europe. It's sort of like pick your poison. Where in the world you think that it could potentially have better information coming
on that call, that downgrade to US equities, HSBC joining us a little bit later this hour, so look out for that. Small business confidence came in about 12 minutes ago, and small business confidence came in lower, 4-month low. There is a nugget in here, though, that got my attention, and I think it got Lisa's too. The share of owners who said it would be a good time to expand declined by the most since April 2020, and a gauge of capital spending plans matched an almost 5-year low. That is not what we want to see coming into 2025. Brian, thank you. It's good to see you as always, sir. Brian Levitt there of Invesco with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. First, I wanted to give you some of the details on that Citi downgrade you mentioned. So it did downgrade its view, as you said, on U.S. equities to neutral from overweight. At the same time, they upgraded China to overweight. They cited valuations, government support for the tech sector specifically, and more generally, a tech breakthrough. HSBC similarly cut U.S. stocks to neutral yesterday, while upgrading Europe. Volkswagen shares surged after it reported a strong result and encouraging guidance, up 3.3%. The German automaker expects to maintain profitability this year, despite muted demand in Europe and rising trade tensions. Volkswagen is also under pressure to stabilize its performance in China, where local manufacturers like BYD are taking market share. And to the downside, Delta shares plunging in the pre-market trade, down 10.6%. If it sticks, it would be its worst day since 2022. It cut its profit expectations for the first quarter roughly by half on weakening travel demand. Delta's CEO blamed a drop in consumer confidence for the decline, but believes that the impact will be temporary. And that's your brief. John.
Danny, thank you. That stock down double digits in the pre-market. One to watch going into the opening bell. Up next on the program, losing hope for the Trump put.
The strike price on the Trump put is lower than we thought. Maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets. And I think it's, sort of a deterioration in the data.
Rob Casey of Signum Global Advisors joins us next, live from New York City this morning. Good morning. Check out shares of Delta down 11% in the pre-market. The guidance was only 2 months old. They came out and slashed it by almost half. In mid-February, consumer spending, business spending stalled out, reinforced by some air safety events. They acknowledge that. They also say this is going to be transitory, that as we work our way through the rest of the year, at least we'll get a rebound.
We'll find out, of course, as the weeks go and policies start to get decided upon. They basically said that this is mostly a domestic issue and that uncertainty was creating a real paralysis when it came to travel, but their full year forecast stayed the same. We'll see. There is a sort of expiration date on how long paralysis can continue before there are potential consequences.
The first big company out of the gate on the S&P 500 to really slash expectations. Equity futures elsewhere bouncing back by 0.4%. Ugly session yesterday. We're up by 0.5 on the Nasdaq 100. Out of surveillance this morning, losing hope for the Trump put.
The Powell put, the strike price on that is lower than we thought, and we learned more about that last week. But also, I think the strike price on the Trump put is lower than we thought. Maybe the uncertainty is hurting to some extent, but also there's something beyond just trade that's driving markets. And I think it's, sort of a deterioration in the data and what that means for the outlook going forward.
So here's the latest this morning. President Trump meeting with top CEOs and Wall Street bank executives today as markets face uncertainty and recession fears. Bloomberg's Tyler Kendall joins us from the nation's capital for more. Tyler, this could be box office later this afternoon.
Right. Well, John, we are expecting those members of the Business Roundtable to try to seek some firmer guidance from President Trump as this White House continues to not give us any indication that they plan to change their policy rollout, which has been marked by so much uncertainty and contributed to this remarkable shift in market sentiment in only 50 days. We have to remember that is only how long President Trump has been in office. And just yesterday, a statement hit our inboxes right after the markets closed with a White House official appearing to blame this on emotion instead of fundamentals, writing, quote, "We want to emphasize that we're seeing a strong divergence between animal spirits of the stock market and what we're actually seeing unfold from businesses. We've repeatedly been pushed towards by officials recent examples of investment under this new administration, such as last week, for example, TSMC pointing out $100 billion in new investment as sort of evidence that these plans that the White House is starting to put into will have longer term impacts. But at the same time, the question becomes, will the White House make any assurances of any kinds as we try to seek more certainty from this White House, or whether or not they will continue to double down that this is all part of a broader macroeconomic plan and consumers and investors alike need to be patient. I actually had the chance to catch up with NEC Director Kevin Hassett at the White House yesterday, who told me that until President Trump's full policy plans are implemented, there's actually only so much they can do to counter what this White House has been pushing as structural issues left behind by the Biden administration. But, John, how long that argument can go on for remains to be seen, and we could get some answers later on today. 5 p.m. Eastern is when President Trump is set to address the Business Roundtable. We're still chasing exactly who will be in that room, but no doubt they're going to want some firmer guidance.
Tyler Kendall of Bloomberg. Looking forward to your coverage later on this afternoon. You know the cheat guide, Biden data, right? So it's Biden data.
Biden data, Biden mess. We need to come up with policies to fix it up.
I think it's a stretch to suggest that the small business confidence read this morning is Biden data.
Which raises this question of how seriously is President Trump going to take it when he meets with his business roundtable later today?
Rob Casey of Signum Global Advisors with us around the table. Rob, good morning. Morning. It's good to see you. Chuck Robbins leads that business roundtable of Cisco. Reportedly, we could be expecting JP Morgan's Jamie Dimon, Citi's Jane Fraser a little bit later on. What do you think the message is going to be to those guys?
Well, I think the message is going to be have a little patience, have a little faith, right? And maybe look through a little bit of the uncertainty that we've seen over the past couple of weeks. Now, that's probably going to be the message. I'm not sure it lands.
When it comes to Chuck Robbins, in January, when he talked about the wild card, he called it, in terms of trade policy, he said he wanted to see a surgical approach. Are we seeing anything of a surgical approach when it comes to what they're doing right now on tariffs?
No, I think so far the threat of tariffs has been a blunt instrument, right? It's not the scalpel approach that Trump has talked about. Going forward, could it be, sectoral? Could it be pulled back a little bit? Yeah. Honestly, I think so. We don't think we're going to see universal tariffs. I think that's baked in. We also, frankly, don't think that on April 2nd we're going to see a snapback of 25% on Mexico and Canada. So maybe it gets, a little bit more targeted, or at least broadly targeted towards Europe, I think, generally speaking. But it's a blunt instrument, and we haven't seen the sort of, I think, very Scott Bessent preferred, very targeted approach that maybe we could have.
When it comes to the market sell-off, is that enough to push the administration to hold back on the 25% we're expected tomorrow on aluminum and steel?
On aluminum and steel, no, we don't think so. Frankly, that is a domestic industry that President Trump really wants to protect. It's a domestic industry that has asked for these tariffs. So unlike autos, et cetera, that have been pushing back on the threat of tariffs, aluminum and steel want to be protected, right? U.S. aluminum and steel want these tariffs on. So we expect that they will be on as of tomorrow.
To build on what Annmarie was getting at there was this theory heading into 2025 that there was a Trump put, that ultimately that would be the ultimate check on the Trump presidency. If the market really did tumble, there would be a response. What are we saying now is the check?
Well, I think there still is a Trump put. It's just a little bit lower and maybe a little bit more painful than we would like, right? But when, as we go back over the course of the past 50 days, the vast majority of tariff threats that Trump has made, he either hasn't followed through on or he's reversed the next day in the case of Canada and Mexico.
Maybe so, but that hasn't given a boost to markets that are still grappling with a great deal of uncertainty. And we haven't even seen the bazooka, the big one that's coming on April 2nd. Some people have suggested that maybe it's the polls, and that right now polls are hanging in there. That frankly, Donald Trump's support is a little bit lower than where it was at the beginning of the presidency, but it's still significantly above where it was the last time around. So do you agree with that idea?
Yeah, I agree with it, but not in the sense that Trump is looking at polls day to day, right? He's never going to run again. A couple of clients every once in a while will push back on the idea that maybe he will run again in 3.5 years. I would not expect that. But I think the mechanism for the Trump put, or at least the Trump concern around polls, is not Trump polls, they're congressional polls, right? If I'm running in a red or purple district in a year and a half, I'm going to President Trump and saying, please, please, please allow me to run on something positive, right? And we haven't seen that so far.
Well, he lashed out last night at one congressman saying, I'm going to primary you if you don't sign up for my continuing resolution that's going to hit the House floor today. Does it pass?
We think it passes the House. Or potentially could pass the House. We don't think it passes the Senate, frankly. I mean, Democrats have to take a stand somewhere. This is really the only place that they can take a stand, right? When it comes to reconciliation, they can't do anything to stop it. But when it comes to this CR, as much as Speaker Johnson wants to call it a clean CR, it's really not. And so we think, even if Republicans can get it over the line in the House, it doesn't pass the Senate.
So they rather take the blame potentially for shutting down the government?
I think so, honestly, and we're hearing Democrats go back and forth. But yeah, I mean, listen, this is not a clean CR, right? And so I think Democrats will try and message that. We haven't seen much messaging from Democrats over the course of the past 50 days at all. But that's assuming that Republicans in the House can get this over the line. And frankly, it's not only Massey who is a no as of now, right? We've heard that Trump has made calls over the course of the past 24 hours to get Kat Kammack and others over the line. They have, obviously, I mean, we've said it every day, they have a very slim majority in the House, maybe a little bit wider because some Democrats are staying home, but it's going to be really tight.
Rob, good to see you. As always, thank you, sir. Rob Casey there of Signum Global Advisors. If you are just joining us, equity futures are bouncing back by 1/3 on the S&P. Yesterday, the biggest one-day loss on the S&P 500 of the year so far. On the Nasdaq 100, the biggest one-day loss going back to 2022. There have been some downgrades out there, including this one. In just a moment, we'll catch up with Alastair Pinder of HSBC after downgrading US equities in the last 24 hours to neutral and upgrading the rest of the world. We need to talk about Europe with HSBC in just a moment. Live from New York City this morning. Good morning to you all. This is Bloomberg TV. Let's check out the scores this morning. Equity futures on the S&P 500 bouncing back from yesterday's losses, but it's not much of a bounce. Up by 0.4% on the S&P, on the Nasdaq up by 0.5. Yesterday, the biggest daily loss of the year so far for 2025, taking the losses to about 9%, almost 9% lower from the all-time highs of only a month ago. Those all-time highs feel like a lifetime ago.
Let's put that into market capitalization perspective. Since February 19th, the Nasdaq is down $4.2 trillion worth of market capitalization. This is a massive amount of wealth that has been removed from this equity market.
It's not just tech either. Discretionary stocks, led by Tesla, of course, but beneath the surface, other names as well have been hammered. They're down 20% from the highs of December. The banks, the KBW Bank Index, wiping out the gains from the post-election rally.
Since February 18th, the KBW Bank Index is down almost 16%. That is traumatic. And you have to wonder how much this is reversing some of the trade from the end of last year and how much this is looking at exactly what the NFIB survey pointed to, which is stasis when it comes to investment and when it comes to deal making.
The only good news I've got for you from the last 24 hours is bonds did what bonds should do, and they rallied, particularly at the front end of the curve. Yields dropped by double digits, down by about 11 basis points on a 2-year this morning, up by 2. The 2-year at the moment, 390.60. 10s right now at 421.87. Lisa mentioned a small business survey coming through at a 4-month low. Plans to expand dropping as well. Everything just moving in the wrong direction at the moment in the survey data. Want to finish on foreign exchange and take a sneak peek of what's happening with the euro. Euro dollar shaping up as follows in the FX market. The euro at about 108.88 and positive by 0.5%, getting closer and closer to 109. On our radar this morning, shares of Delta Airlines falling in pre-market trading after the company delivered a disappointing forecast. Delta cutting its profit expectations for the first quarter roughly by half on weakening travel demand. That stock down 11%.
The problem here is the pace of the decline. The fact that in January, Ed Bastian, the CEO of Delta, came out and said that demand is about as strong as it's ever been, and that, frankly, the demand-supply picture is very balanced and very good. All of a sudden, people aren't traveling anymore, and it was mid-February, and he said that this is a U.S. domestic issue. He does expect it to subside. But the speed of this is what's going to get people's concern, and the reason why soft data right now might be more important to people than backward-looking hard data that tracks an economy that might have looked very different, say, a month ago.
You can make up a lot of excuses for this. You can say that seasonally, the first quarter for the airlines is not great. It's difficult to predict. You can say this was reinforced by the air travel safety events of the last month as well that made people nervous. And maybe as the year progresses, we'll work our way through this. But I think there's some obvious things to point to that could stick around. If you're a federal worker right now, I wouldn't be booking a vacation. I'd probably be cancelling my vacations. And a whole load of people around those people, these things can unravel and bleed out through the rest of the economy pretty quickly.
It's not only the threat of potentially losing your job. If you have lack of conviction, how do you go out and pitch business? How do you go out and try to make deals? These are some of the things that we have seen trickle into the soft data. Delta's still seeing the same full-year forecast. At what point does that materially shift the trajectory versus just being a short-term uncertainty blip?
And let's see if the other airlines follow. We'll be looking out for them throughout the next couple of days, that's for sure. Let's turn to this story. Canada slapping a 25% surcharge on electricity it provides to Minnesota, Michigan and New York in retaliation for President Donald Trump's tariffs. The move coming ahead of fresh U.S. tariffs on steel and aluminum set to take effect tomorrow.
So this is really the first blow of the whole tariff agenda. These retaliation in terms of energy Ontario provides to a number of states in the U.S. Donald Trump late last night came out and said, we don't need your cars, we don't need your lumber, we don't need your energy, and very soon you will find that out. Well, I think a lot of businesses, and even anecdotally, I spoke to a board member of a lumber company in Maine. Anecdotally, they'll tell you all of our energy is coming from Canada. We ship our product to Canada, and then they bring back the finished material to the United States. This is going to get tough, and Doug Ford yesterday spoke to Kaylee and Joe on Bloomberg TV and was saying Trump has created this chaos, and he says this has unleashed patriotism in Canada they have not seen.
Lisa talked about this a few times over the past weeks, the potential for that to start happening. It's very difficult to forecast to see the consequences of increased tariffs, primarily because of how others might respond to it, but also for how the market responds to it as well. One thing that surprised us all, tariffs up, dollar weaker not stronger. The euro stronger again this morning, 108.83. We're up by 0.4%. I want to talk about the latest out of Germany. Germany's Greens saying they are ready to negotiate a defence spending deal and are hoping for an agreement this week. This coming after the party rejected a debt finance package that would unleash hundreds of billions of euros in spending. I want to stick with Europe. The EU looking to boost investment and prepare for expected tariffs from President Donald Trump. Bloomberg's Ollie Crook joined us from Germany in the heart of German business. Ollie, walk us through what you're hearing from the likes of VW about the latest push in Europe.
Yeah, so Jonathan, I mean, you talk about the sort of uncertainty that's been thrown up by the Trump administration on the question of tariffs. I mean, this is a sort of front and center for here, Wolfsburg, Germany. This is one of the biggest manufacturing sites in the world, probably the biggest factory in Germany. This is where Volkswagen really made all of its cars historically. This is, got huge assembly lines and absolutely massive in terms of generating output of cars. And this is sort of in the sort of center of the discussion here because Volkswagen has had to face the reality of a sort of much tighter squeeze in China. They've had to have a much slower situation here in Europe. They've had to cut down assembly lines. This used to put out 4 lines. They're moving this to 2. What they've had to focus on is their growth market, and that is the United States, right? And that is what is coming into complete sort of disarray now. I spoke to the CFO a little bit earlier. Nobody really wants to give you a sort of scenario of what 25% tariffs looks like. They all say wait and see. But have a listen to what Arno Antlitz, the chief financial officer of Volkswagen, had to say to me earlier.
We feel already like an American company. Look, we operate a huge factory in Chattanooga with thousands of people there. Volkswagen Group of America employs more than 20,000 plus people, create safe and well-paid jobs. We invest in South Carolina. So we think these should be taken into account when talking about tariffs and Volkswagen and talking about the U.S.
So you can hear it there from the executives, the kind of the pitch to Donald Trump of why they should be sort of exempt from tariffs. But it's not just about tariffs between Europe and the United States. A huge part of the Volkswagen strategy has been establishing a battery factory in Canada, establishing the VW Gulf factory over in Mexico. All of these things are being caught up. And listen, I spoke to a number of executives over the last 24 hours, really pressing them on what tariffs would mean. Nobody wants to give you a whole lot. But what I can tell you is that this is a market, the United States market, that they want to double their market share in. It is the only major market that grew last quarter, and they will hold on to it to the bitter end. So if that means augmented capacity in the United States, I suspect they're ready to do it.
Those plans have been totally upended in many ways over the last month or so. Ollie, appreciate the breakdown. Bloomberg's Ollie Crook there, the latest from VW and some of the automakers and some of the challenges they face right now. These are some of the challenges that investors face too. And what are they doing? They're fleeing into European markets and downgrading US equities. Alastair Pinder of HSBC writing, prior to the US elections, we assumed a Trump victory would reinforce US exceptionalism. We are upgrading Europe, excluding the UK to overweight. We are downgrading the US to neutral. Alastair joins us now for more. Alastair, good morning. Good to see you.
Thank you very much for having me.
Let's talk about the reasons behind that call. Start of the year, you were thinking what a lot of people were thinking. US exceptionalism. What changed?
So what did we underestimate? We underestimated the potential for governments to essentially retaliate to tariffs and, retaliate to the wavering support to Ukraine and also defense spending from NATO with their own fiscal stimulus. And we saw this in China with the NPC, and we're now seeing this in Europe with Germany embarking on what seems to be pretty sizable fiscal stimulus, almost 1 trillion euros split between defense spending and infrastructure spending. Again, for me, the real catalyst is the infrastructure spending here, because I think that's going to what has the real repercussions for economic growth. And we're starting at a place where actually Europe looks very cheap. It had been completely disowned by investors. It was trading at a significant discount to US markets. And we're now seeing the stars kind of align. And you mentioned the euro, it's 108. But, for the majority of the year, it had been depreciating. It's still below its highs. That's also a modest tailwind for earnings as well. So the backdrop, in my view, is turning very favorable for Europe at this point.
We've been talking about whether it's the U.S. pushing money out of the domestic market or if it's the rest of the world sucking money out of the United States market. Where do you fall on that question at a time where it's less, at least according to your note, about U.S. policy and more about better opportunities elsewhere?
I think it's definitely the latter, as you mentioned. I think, one of the things that we're seeing in what gets you excited into going to other markets internationally, you have to see investment opportunities. And I think, the 2 biggest conviction calls that we have at the moment has been China and has been Europe, and both of them have been driven by their own catalyst. In China, it has been fiscal policy and DeepSeek, and that's been driving the internet sector. In Europe, it has basically been the shift in mindset of governments, which is going to basically unleash fiscal spending and support, economic growth. And I think that, for me, is what's going to drive people into Europe rather than the other way around.
What's the risk that this is all good? You get this incredible rally, as we've seen in European equities, until April 2nd. And then Donald Trump comes out with the big one, and it's the reciprocal tariffs. And all of a sudden, people start thinking about what the financial repercussions are for places like Europe. And suddenly, the fairy tales are over, and you're dealing with fights in different legislative bodies over what kind of spending you could have. How big of a risk is that?
So let's put some numbers into context here. So 25% of European equity markets revenue comes from the US. That's a lot. But actually, a lot of that is not exposed to tariffs at all. So services, like software and services, don't get tariffed. And actually, there's a lot of companies that produce in the US and sell in the US. That's avoidant of tariffs. So actually, net, what do we think is, exposed to tariffs? Less than 10% of revenue. So much less than what people, I think, assume. And it's very specific in certain sectors. It's the consumer staples, some consumer discretionary, and also the autos, of course. But outside of that, I think in the industrials, I think in the tech, I think in the financials, I think they're going to be much more resilient to the tariff risks than people believe it.
So right now, would you advise avoiding those tariff vulnerable sectors?
Yeah, I think that's, that would be our policy, is 100%, be more sheltered into areas which are resilient to tariffs. And, that's, again, on a global basis. I think that's a theme that we see in the US, where, again, we would be more cautious on the consumer discretionary consumer staples sector, where they import a lot. And so, therefore, they're more vulnerable to tariffs from an earnings hit. But it's also the case, again, I keep highlighting China here, but China's equity market revenue from the US is just 3%. It's negligible. It doesn't make a difference. So again, I actually think China, despite all the tariff headlines, is actually more of a defensive play from an international context.
Do you think there's a point at which the administration steps in? The so-called Trump pill has been talked about a lot. Do you think there is a pain threshold for not just the Trump administration, but also for the Federal Reserve as well? And in your mind, I imagine we're not close right now, but how much closer are we?
I mean, I don't think we're at that point, but I do think we're getting to the point where if you look at what markets are pricing, we talk about a lot about these recession risks. I think we're pricing in a lot of recession risk at this point. We have a probability of what equity markets implying that's jumped up 10-15% over the last week alone. If you look at the typical equity market performance during recessions, it's around 10 to 15% downside. We're pretty much there. For me, I feel like we're pricing in a lot of downside. Can it go lower? Yes. But at that point, you're going to see bond yields start moving lower. You're going to see that Fed put come in. And so again, I think you're completely right. I mean, going to your point earlier, we do have this risk event on the 2nd of April. But beyond that, I actually think the outlook is much more favourable.
Just out of interest, do you think that view about the growth scare in equities is being confirmed by fixed income? We saw high yield spreads blow out just a little bit yesterday. Do you think it's being confirmed by what you're seeing in high yield?
I mean, I think it's being confirmed by what we're seeing in the 10-year bond yield, right? Which is that you're seeing that roll over pretty sharply. And again, that's seeing this underperformance of cyclical stocks versus defensives at this point. So yes, I think we're seeing that reflecting across most asset classes at this point.
Alastair Pinder of HSBC, thanks for joining us. Appreciate it. Downgrading US equities. Saw something similar from Citi in the last 24 hours. Lisa, that view on a high yield's one to watch. Yes, spreads have started to widen out, but if you look at absolute levels of around 300 basis points, people might sit here and say that's still pretty tight.
Yeah, some people might also argue that it isn't necessarily the canary in the coal mine that it used to be because of the dampening effect of private credit, and that's the reason why Alastair went to the 10-year yields. There is this question, and the reason why I'm actually very curious to get CPI tomorrow, a question of if it comes in hotter than expected and inflationary pressures are still there, how much does that force the Fed's hand and actually raise the bar that much higher for them to really provide that relief valve on the other side with potential cuts?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
That's the fear, and that's the reason why, if there is an upside surprise in that CPI report, people might actually take notice. It's just one to watch at a time where that is one of the concerns out there.
So bearish, just kind of.
Okay, well, I mean, the market yesterday was pretty. Okay, what do you want to do?
Take a shower. Equity futures on the S&P. That's what I want to do. It's not a suggestion. We're up by a third of 1% on the S&P. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Some breaking news earlier in the hour. Shares of Southwest down 2.7% in the pre-market. It is ending its free bag policy. Customers will be charged for their first and second checked bags unless they hold top-tier loyalty status or are traveling on a business fare. The changes apply to flights booked on or after May 28th. Oracle shares also lower in the pre-market, down by nearly 2%. It had disappointing quarterly results. Its sales and profit forecast for the current quarter also fell short of analyst estimates. Oracle did report a surge in bookings, though, and said its cloud infrastructure business will boost revenue over the next 2 fiscal years. Elon Musk has blamed what he calls a massive cyber attack for widespread disruptions on his social media platform X. Tens of thousands of users globally reported intermittent outages on the app, with new posts failing to load for users. Darkstorm, a pro-Palestinian so-called hacktivist group, took credit for the attack via its Telegram page without providing proof. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, Tesla in the headlights.
Your stock is way down. You've been criticized left and right. Why are you doing this?
It is tough sledding. But I think we're doing the right thing here.
How are you running your other businesses?
With great difficulty.
Tesla stock having great difficulty. JoAnne Feeney of Advisors Capital Management joins us to talk about that and a whole lot more from New York City. This is Bloomberg. Equities a little bit firmer, up by a third of 1% on the S&P. On the Nasdaq 100, terrible day yesterday, up by 0.4% this morning. Under surveillance this morning, Tesla in the headlights.
Your stock is way down. You've been criticized left and right. Why are you doing this?
It is tough sledding. But I think we're doing the right thing here.
How are you running your other businesses?
With great difficulty.
But there's no turning back, you're saying?
I'm just here trying to make government more efficient, eliminate waste and fraud, and so far we're making good progress.
So here's the latest this morning. Elon Musk Tesla facing its worst day in more than 4 years in the last 24 hours. The stock looking to recover this morning after tumbling 15% yesterday. The Nasdaq 100 posting its worst day since 2022 with more than $1 trillion in value wiped out. JoAnne Feeney of Advisors Capital Management joins us now for more. JoAnne, it's been too long. Welcome back to the program. Let's talk about this correction we've seen in big tech, how you view things, what's driving it, and whether now's the right time to step back in.
Yeah, good morning, John. You know, there's obviously a lot of fear out there in the market. We've seen the VIX spike up, and the fear is centered on the uncertainty that investors and businesses now face because of the back and forth we're seeing on the potential tariffs that we're going to see not just on Canada and Mexico, but Europe, and then on specific industries, whether it's timber out of Canada or aluminum and steel. So that level of uncertainty creates a lot of challenges for businesses. They tend in these moments to want to pull back on things that have an irreversibility component to them, capital investments and even hiring. It's not so easy to fire people once you've hired them. And so we see the businesses in some sense freezing in place. And I think the Delta results kind of, helped, confirm that. Business travelers are down, even consumer traveling is down. And I think that's a sign of businesses tightening their belts and saying, let's wait and see what happens.
Let's look on the bright side. Do you like that, John? Is that
nice.
Good? Yeah, let's look on the bright side. A lot of people were really optimistic about U.S. dynamism, and now you can get it at a discount. Why not go in now?
Well, there's good reason and good opportunities out there right now, Lisa, and that's because there are still pretty good growth drivers in some areas of the U.S. economy. And the U.S. as a whole doesn't have to be exceptional for there to be good opportunities. I mean, the AI revolution is still ongoing, and there's really not a lot that's happening now that's likely to disrupt that. We're still seeing major investments in data centers, and even after the DeepSeek scare, right? Companies that are putting their money where their mouths are saying there's still a lot we want to be able to do with AI, and we're going to continue to invest to make that happen. So those companies in the middle of that are still, in fact, better opportunities now than they were a few weeks ago.
So are you buying?
We have pretty full positions where we want to. We've owned NVIDIA for a long time. We've owned Broadcom for 10 years. And we've owned a few select others in the software space, in particular, like a ServiceNow, for example. We don't think that it's wise to try to time this market We don't know when sentiment is going to change. Obviously, there's been a risk-off trade. Investors that weren't diversified are trying to get diversified. So we're seeing other stocks in the market do relatively well. But it's always tricky to try to say, well, uncertainty, we know there's a lot of it. Maybe we should back off of growth. But if you're a long-term investor, this might be a time, if you don't have a full position in names like the ones I just mentioned, it might be a good opportunity to get in there, even though these things could still go down for a while this uncertainty plays out.
Jonathan kicked off the conversation showing how bad of a day Tesla had yesterday. Do you think there's going to be political blowback, not just when it comes to Tesla and you see some of the registrations plummet when it comes to those cars being bought in places like Germany because Elon Musk and backing the AfD, but also places like Canada? Will there be a boycott of American goods?
Annmarie, we're starting to see that. In Canada, they're taking American liquor off the shelves. We've seen surveys that show that Canadians are buying less goods out of America, whether that's from Amazon or others. So, we're seeing that certainly. And if you look back historically, we've seen this sort of thing before. Whether it was the 2018 tariffs or all the way back to Smoot-Hawley, we did see other countries respond either with retaliatory tariffs or simply with protests. And that caused, in some cases, back in the Smoot-Hawley era, exports to those countries drop as much as 23%. So those are real concerns that one has to watch out for. That's why, you can position away from some of the products that are in the, squarely in the headlights of this sort of risk. I mean, invest in more domestic companies, McDonald's, Altria, things where demand is less elastic. These kinds of companies are likely to do better in this kind of an environment.
JoAnne, you mentioned 2018. How useful is that period as a playbook? Because the drawdown back in 2018 was far more substantial than the one we've seen so far on the S&P 500.
Yeah, it's hard to tell, Jonathan. I mean, clearly the tariffs that are being bandied about now are much bigger than those in 2018. So if they were to go into effect, the economic effects would be larger. But, now we have something we didn't have back in 2018. We have this AI revolution. It's not just for the picks and shovels providers like NVIDIA and Broadcom, but it's also for those that could adopt AI to make their businesses more productive or to create new products. So we have a growth engine that's real, that's identifiable, and that's multi-sector that we didn't have back then.
JoAnne, appreciate your time, as always. Breaking down some of our stock picks this morning. JoAnne Feeney there of Advisors Capital Management. One name that was mentioned, let's talk about Delta. Delta down in the pre-market by close to 10% at the moment after slashing their outlook for Q1. So much of the soft data is about feelings. I feel this way, I feel that way. This is more than that. They're telling you what consumers and businesses have actually been doing since mid-February. And those companies, those people have been pulling back.
What they've been doing is nothing, and nothing has a cost. Nothing is a choice, as you've pointed out. So there's a question of how long this can continue before it starts showing up in the hard data and has some lasting effects. Right now, Delta is saying there still is a reversibility to this. What does President Trump have to say today at that business roundtable to get the confidence of business CEOs?
He's going to get a bit of a grilling, you have to think. When you have the Delta executives coming out and saying consumer spending started to stall. They're saying they're not telling us they're going to do this. To your point, Jonathan, they aren't booking the flights. What I thought was interesting about Delta is they're seeing this more domestically. I wonder if this puts a cap on U.S. exceptionalism because they're still seeing people buy some flights when it comes to international travel.
The President and Secretary Besson have been pretty consistent. Is the message really going to change today? That we're going to end up in a better place? We're rebalancing the economy. There might be some disruption, but bear with us.
You have to imagine they're going to stick with it.
It's the message so far. Let's see if it changes. Up next on the programme, we'll catch up with Scott Lincicome of the Cato Institute, Holly O'Neill of Bank of America, Kelsey Berro of JP Morgan Asset Management. The second hour of Bloomberg Surveillance. Up next.
The focus has shifted dramatically to the downside growth risks for the U.S. economy.
We've had a weaker view of the economy, going into this year already, and I think we've seen that in the data.
High inflation is going to be what it becomes more problematic for the American psyche.
Those animal spirits that we were talking about just 2 months ago, I think that's been replaced by recession fears.
I don't think it's a United States recession. I think it's a Washington, D.C. recession.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now, and your day ahead looks a little something like this. Three things to watch. Later on this morning, some more economic data. Look out for jolts. Job openings. Another read on the labour market coming later this morning. Look out for the press briefing from the White House later on this afternoon. And then this one, 5 p.m. Eastern Time. The President of the United States sitting down with business leaders for the Business Roundtable. Cisco's Chuck Robbins leading that, and reportedly we could see JP Morgan's Jamie Dimon, Citi's Jane Fraser in the room down in Washington, D.C. at the White House at a time when we came into 2025 with business confidence sky high. That business confidence slowly being eroded on the back of the policy uncertainty over the last month.
You asked last hour, is there any reason for them to change the stance that they've had already, which is essentially this is by design. Stick with us, have faith. We are going to have a grand plan. It just is going to take some time. Is there any reason for them to change that tone right now within the Trump administration when they talk to business executives at a time where there is a wobble in the stock market? But they have said they're okay with that. There is a transition period. There is a detox period. And so that is really going to be the tension this afternoon.
It's coming at a time when we've seen a series of downgrades from economists and from investors alike. I'm thinking of Mike Gapin over at Morgan Stanley, who downgraded the growth outlook for America, upgraded his inflation forecast. Investors doing the same thing. We spoke to HSBC about 25 minutes ago. They've downgraded US equities. Citigroup has done exactly the same thing. Citi pointed to the idea that better news will come from elsewhere. That better news won't come from the United States, at least for the next several months. Why? Because we want some policy clarity around things like tariffs, and maybe for the next several weeks, we won't get it.
We might not get it, but that is the one question I think all of these executives that are going to have a chance to speak to the president today at 5 p.m. at this business roundtable are going to ask. They want to have a dialogue, and they want some sort of clarity when it comes to the tariffs and trade headlines. Also interesting, when you see advisors that are close to the president, maybe outside the administration, something else you see a lot of people pushing for now, and potentially this shows that the administration is concerned about the market downturn, even though they've doubled down on their language. They want to bring up the tax cuts. The sequencing is key here. And I imagine all these executives want to know when that bill might get signed.
Up until recently, this has just been talk and feelings. In the soft data, we feel like things aren't going so well. We feel a certain way. Now I think it's action. With the move from Delta Airlines over the last 24 hours, after the close yesterday, slashing its outlook, the stock down this morning by 9% in the pre-market, and the company coming out and saying this: a recent reduction in consumer and corporate confidence caused by increased macro uncertainty driving softness in domestic demand. Ed Bastian, the CEO, saying that in mid-February, companies, consumers, activity started to stall. Now, they're making the case that maybe that's transitory and it bounces back in the next several months. The fear is it won't.
And the fear is it is happening so quickly. Ed Bastian in January said the supply-demand balance is as good as I can ever recall it being as we look into 2025. And now, just 2 months later, it is a completely different story. They still are maintaining full-year forecasts, but the speed, and we keep going back to this, the speed of the shift in tone is shocking, and it has gotten a lot of people attention. And we've asked this question before, John. Who is going to be next at a time where this is really going to be the ongoing theme?
The answer to that is American Airlines, right on cue. They say the revenue environment was weaker than expected. The outlook for the first quarter, Lisa, adjusted loss per share of 60 to 80 cents. They had seen a loss of 20 to 40. They say revenue environment weaker than expected. They say this also. They cite Flight 5342, softness in domestic leisure. Now, this is the issue that Delta brought up as well, and it's difficult to disconnect the two things. On the one hand, you've got a slowdown in consumer spending, one. Two, you've got the why. Is it because people are worried about the economy, or are they worried about flight safety? And it's very, very hard to divorce the two, and I guess we're going to see in the next several months.
Ed Bastian did refer to this in a recent interview yesterday where he said that there was some kind of ramification from that. American Air citing that, as you just mentioned as well. At the same time, we've had flight issues for a while. They haven't seemed to impede demand to a great degree. Was this different, or is there something else going on? And whether this is confirmation bias or whether this is idiosyncratic, we have also heard warnings from the likes of Walmart. We've also heard warnings from the likes of Target and Best Buy. So this is the reason why not only is President Trump's stance today, this afternoon at that meeting, going to be very important, but if the guidance continues in this vein, it is harder to dismiss this as an idiosyncrasy related to air flight safety.
The 5-day moves have been brutal. You've got American Airlines down by by something like 5% at the pre-market. I mentioned the move we're seeing in Delta. Even before these moves, the 5-day move down 10% on American, United down 15%, Delta down by 14%. It's a whole lot more than just air safety issues. It's certainly a whole lot more than that.
Well, you talked about this, and honestly, at a certain point, you have to wonder, okay, am I being too gloomy? On the bright side, how do we look at this? But if people are getting laid off, or they feel like their companies aren't going to be getting certain federal contracts, or frankly, there just is a paralysis with respect to business investment, why would you double down on travel? Why would you double down on taking vacations? How many people right now are taking long vacations as they try to deal with the barrage of headlines that's headline roulette at this point? Not many, especially not if they're on Wall Street or a business.
Look, I joked about you being too gloomy. I just think this is the reality of the situation. I've said it repeatedly coming into 2025. I'm not scared of saying this out loud. I want them to succeed. I want anyone in the White House to succeed. And what I mean by success, I want to see better hiring, I want to see more investment, I want to see higher levels of growth at a time where we've been blessed with pretty decent levels of growth. Confidence into 2025 was sky high. Why? Because this was going to be a business-friendly administration. And we wanted to see that translate into better hiring, better investment. Confidence for businesses, particularly small businesses, has started to decline. We saw that with the Small Business Confidence Survey this morning, 4-month low. And the plans for hiring, the plans for investment. Look at this for the plans for investment. The share of owners who said it's a good time to expand declined by the most since April 2020. Unfortunately for the administration, that is not Biden data. That's Trump data.
That's Trump data, and you see this show up in a lot of surveys when it comes to consumers as well. Not just the fact that more people are concerned potentially about losing their job, you see the Doge effect, but also when it comes to tariffs, if companies are going to put that price hike onto consumers, they're going to have to pay more for their everyday goods, let alone how can you think about taking a vacation. What is so different, Jonathan, in Trump 2.0 than what we saw in Trump 1.0 was the sequencing. Trump slashed taxes before beginning the trade war. Right now you have this uncertainty, this overhang, this fog of what trade's going to look like before we even get to the tax bill.
There's a chance we work through this. Of course there is. There's a chance we get to a better place. And the strategic anchor of the equity bulls out there remains the same. We understand what they're trying to achieve, rebalance the economy away from public spending towards the private sector. But they acknowledge, even the president acknowledges, there will be some disruption in between. This is the kind of disruption we're getting right now. The data speaks for itself.
The problem is, what are the relief valves? And we talked about this heading into this year. There's the Trump put, the idea that if the market goes down too much, President Trump would come out and respond. That's been pushed off. There's the Fed put, the idea that the Fed will come to the rescue. That's the reason why CPI data is going to be so important tomorrow, and why in that survey from the NFIB, the fact that companies are looking to raise prices at the highest pace going back to 2021 raises some concerns. Does that push off some of the Fed relief valve? These are some of the questions people are trying to grapple with at a time where there's a lot of uncertainty and people are trying to figure out when's the break point where they can get some more clarity.
The small business optimism retreating this morning is going to get the administration's attention, because the only comment we got out of them yesterday was that they think that there's a divergence between what they're saying, what's happening in the stock market and animal spirits, versus what they see unfolding for businesses and business leaders. They think that's more important. When we look at business leaders today, they're concerned.
If you are just joining us, welcome to the programme. Equity futures just about bouncing back, but that bounce fades. We're positive by a little more than 0.1% on the S&P 500. In the last hour, small business optimism falling to a 4-month low in February. Bloomberg's Mike McKee joins us now to break it down. Mike, let's talk about why and what underpins that shift lower, why that softer sentiment.
Well, I think you can see it in one number, and that's the uncertainty index rises to 104, and that's the second highest level ever. It's not like the economy has fallen off a cliff, but nobody knows what's coming next, and it's very hard to plan. So you see the 10 different indicators that the small business owners fill out, 7 of them were negative. 3 were positive, but the ones that were positive weren't particularly great. More job openings that they can't fill, earnings trends up by just a little bit, and then expecting easier credit conditions up by a little bit. And that would suggest maybe people think things are bad enough that we're going to start to see the Fed cut interest rates again.
Mike, can you give us a sense of how much of an about face this is at a time where, as John mentioned, coming into this year, confidence among small businesses was sky high?
Oh, it's a big about face, not only for small business, but for large business as well. And I think it comes back to the fact that throughout the campaign, Donald Trump said, on day one, I will. and day one has come and gone. This is the 51st day, halfway through the 100 days, and he hasn't yet. We haven't seen much except the turmoil of Doge firings in Washington. And so people are starting to say, well, wait a minute, what's actually going on here, and why all of a sudden are we talking about pain instead of immediate gain?
Mike, do you think this now starts to bring up a different conversation at the Fed, maybe bringing up this idea that we can see Fed cuts sooner?
Well, bring up maybe, but at this point, the Fed is stuck like everyone else in not knowing what's going to happen. And we have tomorrow tariffs on steel and aluminum. And then the first week in April, we have tariffs maybe on Mexico and Canada and China and who knows who else. And so as long as there's that uncertainty, the Fed's going to sit tight because the economy is still growing. And inflation is still coming down very slowly, but still coming down. So they don't have to move. So I think they'll be as quiet as possible about the outlook going forward. And we just have to let the markets divine what the Fed is going to do for the time being.
That meeting a week tomorrow. Mike McKee, thank you, sir. Bloomberg's Mike McKee breaking down the softer than expected small business confidence print we got in the last 60 minutes or so. A week tomorrow, March 19th, the Federal Reserve's got to get together, decide on interest rates. Based on the communication and the guidance from basically the whole committee, there's going to be no action next week. But then they've got to put out forecasts, Lisa, and putting out forecasts, I think, gets so much harder. And it's certainly harder than it was the last time they did this.
Why don't they just put out some numbers and say, look, these are made up. We have no clue. We're in a black box right now. And essentially everybody knows that. The dot plot has been gaining a lot less relevance over the years as it's been wrong again and again. So at a certain point, do you dismiss that and start to talk about things like what they have been talking about, which is weighing the idea of softening growth with sticky inflation? How do they measure those two things?
Equity futures right now positive by about 0.2%. Let's get you an update on stories elsewhere, including an update on the latest in the airline sector. In your Bloomberg brief, here's Danny Berger. Hey,
yeah,
Danny.
John, another airline, another dour outlook. This time, American Air, those shares falling 3.4% in the pre-market. It cut its forecast. It reported weaker than expected revenue in this environment. American expects a loss of 60 to 80 cents a share, grappling with weak leisure demand and a fallout from a fatal collision in Washington. Elsewhere, the House Freedom Caucus has backed a stopgap funding package to help Speaker Mike Johnson pass the bill without Democratic support. If passed, the bill would reduce and then freeze spending for 6 months. It would add $6 billion to defense and $440 million to immigration enforcement, while cutting IRS funds by $20 billion. And in sports, Manchester United is planning to build a new 100,000-seat stadium in a bid to modernize its facilities. The stadium will be built next to its current home of Old Trafford, where the club has played for the last 115 years. Man U did not say how much the stadium would cost or how long construction would take. It's set to become the largest stadium in the UK. And that's your brief, John.
Got to make sure they don't get relegated first, Danny. Danny, thank you. More from Danny in about 30 minutes' time.
Who's gloomy now? Look at this.
Fans are going to hate that.
Oh, really? Why don't you cheer up, John?
I'm not taking it back. Up next on the program, Canada retaliates.
I always say when the market speaks, you have to listen. The market is speaking. CEOs are speaking. People are speaking out. I don't believe in protectionism with your two closest friends and allies in the entire world.
Up next on the program, Scott Lincicome of the Cato Institute from New York City this morning. Good morning. Unwinding just a fraction of yesterday's moves on the equity market, up 1/3 yesterday, the biggest one-day loss of 2025 so far. In the bond market, yields were lower across the curve, down 11 basis points at the front end. Further out along the curve, the 10-year up today by not even a single basis point. The 10-year yield 4.2225. And the surveillance this morning, Canada retaliates.
There's one person that will put us in a recession, and that's President Trump. I always say when the market speaks, you have to listen. The market is speaking. CEOs are speaking. People are speaking out. Why is he doing this to his largest customer in the world, Canada? No one buys more products off the U.S. than Canada does, including autos. I don't believe in protectionism with your two closest friends and allies in the entire world.
So here's the latest this morning. Canada responding to President Trump's tariffs on the country by slapping a 25% surcharge on the electricity it provides to Minnesota, Michigan and New York. Trump responding on Truth Social, writing, Ontario just announced a 25% surcharge on electricity, of all things, and you're not even allowed to do that because our tariffs are reciprocal. We'll just get it all back on April 2nd. Bloomberg's Tyler Kendall joins us now for more. Tyler, that relationship is getting more and more tense by the day.
Yeah, John, and later on in that interview, the Premier of Ontario said that he is coordinating closely with Mark Carney, who we have to remember over the weekend in his victory speech said that Canada is now clouded by dark days brought on by a country they can no longer trust, meaning the U.S. We know Canadian consumers have already started to boycott U.S. goods as well as the use of Amazon. But as we look forward here, of course, this administration keeps pushing us towards those reciprocal tariffs on April 2nd as kind of the end-all solution to any of this heightening in rhetoric that we're seeing. But first, of course, is tomorrow, those 25% tariffs on steel and aluminum. We know Canada, for example, is the #1 exporter of aluminum to this country. And at the moment, the White House is telling us not to expect any sort of modifications. That's the word that they use, meaning exemptions or carve-outs, although, of course, all of that can change. And while producers have largely applauded this move, domestic producers in the U.S. wanted to see this, we have to keep in mind that this also applies to those downstream metal products. Think things like car bumpers and wires. We'll be watching closely to see if manufacturers indicate that they will pass those higher costs off to consumers, because while we've been talking a lot this morning of how it appears the White House appears to have this higher tolerance when it comes to a market sell-off, we'll have to see whether or not consumers have a higher tolerance for a tick up in prices, and if that could potentially serve as a check on this administration's policies, since we know that President Trump has been pushing that he will bring down prices.
Tyler, we also know the president will be sitting down with CEOs later today. What are we expecting to happen at this business roundtable?
Well, as you guys have been discussing all morning, it's no doubt that those CEOs are going to want some firmer guidance, some firmer clarity when it comes to President Trump's tariff plans and the uncertainty that has been surrounding them. But we should also point out that the last time President Trump addressed the business roundtable was when he floated that he would put forward a lower corporate tax rate. And there is no doubt that they are going to be looking for any sort of assurances there when it comes to President Trump's tax cut agenda, which Annmarie, we know, is already starting to face some pushback in the U.S. Congress. Not necessarily that lawmakers don't want to see it through, but how it is going to get through, particularly whether or not his 2017 tax cut plan can be made permanent, or whether all those other tax priorities like no taxes on tips, overtime pay, or Social Security can end up being on the table if Republicans can find those pay-fors.
Tyler, appreciate the update. Tyler Kendall in the nation's capital down in Washington, D.C. Joining us now to extend the conversation, Scott Lincicome of the Cato Institute. Scott, welcome back to the programme, buddy. It's good to see you, as always. Let's just take a step back. Can you think of a historical parallel that speaks to the moment we're in right now regarding trade?
You'd have to go back a long way. I mean, you're really looking at Smoot-Hawley level tariffs if these reciprocal ones kick in and this everything else we have so far. It really has been that long. One of the, I think, mistakes people make is looking at the first Trump era and saying, oh, well, that didn't hurt. Those tariffs didn't hurt the economy that much. But we're talking in terms of both the size of the tariffs and the speed of them. It really dwarfs anything that we saw last time around. And I think markets are reacting accordingly.
We also see trading partners react. Ontario putting tariffs on electricity going to certain states in the United States. What kind of retaliatory measures are you expecting as well?
Yeah, the thing that I'm looking at most are asymmetric retaliation. So not tit for tat tariffs on goods because from the United States, because, those tariffs are going to hurt Canada or Mexico or China as well. But there are a lot of other ways that countries can retaliate against U.S. businesses that are less painful for them and more painful for the United States. You mentioned, export taxes on electricity, boycotting American liquor in Canadian liquor stores, but the Chinese removing business licenses for certain American multinationals. There are all sorts of ways that governments can go after U.S. interests without just simply slapping tariffs on stuff.
Scott, in Trump 1.0, we saw carve-outs and exemptions, especially from downstream companies, for those companies that maybe make products when it comes to steel and aluminum, which we get those tariffs tomorrow. Are you expecting any sort of exemptions?
I think in the longer term, there has to be, but it really, we just have to wait and see with this administration. We're not just talking about steel and aluminum that's more expensive here in the United States. In a lot of cases, you're talking about steel and aluminum that simply isn't made in the United States. And in some cases, will never be made here because it's specialty items, for example. In those cases, American manufacturers are just going to have to eat the tariff. And that's a major cost hit for a lot of companies that produce things that are really reliant on those metals.
There's this ultimate goal of bringing production back to the United States. This is something that President Trump has talked about, which is the reason why I was really struck by an automotive news study that shows that about 1/3 of U.S. auto parts suppliers, they would move production out of the United States if 25% tariffs on Canada and Mexico stick. Can you explain this counterintuitive trend that actually might do the exact opposite of bringing manufacturing to the United States?
Sure. Well, we have to remember two things. One is that there are places that have lower production costs than the United States, of course. But second is that the U.S. consumer market simply isn't driving the global economy bus. And for a lot of companies that have business elsewhere, there isn't an incentive. Just move your business that you aren't serving the United States offshore to places that don't have high tariffs on your input costs, don't have all this uncertainty, and don't have the threat of retaliation if you're potentially exporting. So, it's just a numbers game for a lot of these companies. And oftentimes, the economic reality is that numbers make more sense to move your business out of North America, out of the United States, than to pull it in.
Scott, some people have argued that the ultimate goal of this administration is something that everybody can get around, the idea of reducing waste in the government, the idea of broadening out the middle class and bringing certain types of business back to the United States. A lot of people have been talking about that on both sides of the aisle. Is there anything that you see going forward that really does give you hope and optimism that maybe even some of these negotiations will ultimately lead to lower tariffs, or there could be some sort of clarity that comes after April 2nd that gets us closer to that place?
I wish I could be really optimistic here, but the last couple months don't give me grounds for confidence. Yes, I think you could see a few tariff reductions in a few markets. India lowering tariffs on motorcycles, or the Europeans maybe trying to lower tariffs on cars. But the reality is that this shoot first and negotiate later strategy creates intense geopolitical and political problems for foreign countries. It's really difficult for leaders that have to win their own elections abroad to cave to Donald Trump and suddenly liberalize tariffs. And that's why over the years, countries have engaged in free trade agreement negotiations to lower tariffs overall, to not do this reciprocal tit for tat thing, but instead kind of achieve a general level of liberalization that matches while protecting certain sensitive industries. That has tended to work pretty well, including for the United States. But this strategy of using tariffs to bully other nations into lowering their trade barriers, it didn't work much during the first Trump administration, and it hasn't worked much in the 80s and the 90s, and I'm worried that it's not going to work very well again today.
Scott, Lisa's trying to be optimistic. You're not helping. Scott Lincicome there of the Cato Institute. Scott, appreciate it. Thank you. Up next, Holly O'Neill of Bank of America on the state of the U.S. consumer. From New York, this is Bloomberg. Lisa's mood's turned happy, almost optimistic, constructive.
You asked for
happy
this.
Happy because the market's down, or happy because you think things should be better?
You told me to take a shower, so I took a shower.
No, I said
washed it off.
Yeah. I said I needed one. That's different. Equity futures right now in the S&P, positive by 1/3 of 1%. If you're just joining us, I'm not explaining. On the Nasdaq, up by 0.4%. Let's get you some movers 2 hours away from the opening bell. Your morning movers with the wonderful Manus Cranny. Morning, Manus.
Jonathan, a very good morning to you. This market is the most oversold since 2023, but there's no good news at Delta. What you've got here is a great and fast unwind from clarity and vision at the start of the year on earnings to a knock of 50%. 30 to 50 cents, that's what they're going to earn. We were looking at 70 to $1. This is about lowering the guidance. The question is whether it's a domestic US fissure in confidence, and does it morph into something which knocks the premier front part of the plane on the transatlantic route. Right now, down 8.1%. Tesla down 15% yesterday. You've got that. The worst day since 2020. The halo effect is gone. In other words, that Trump bump by association is now gone. President Trump says he'll buy a Tesla today to show support for Musk. The reality is it's about deliveries. UBS say down 16% in the quarter, down 5% on the year. I leave you with a view on Oracle. This is about a divergence between the numbers and the guidance, down 1.2%. Safrakat's the CEO says more capacity is coming online. Our revenues will grow in 26-27. The market is impatient. Larry Ellison talks about hyper-growth. I leave you with a thought. The cloud. Infrastructure, application and revenue, all lighter than the market had estimated. This is about the data and the figures versus rhetoric and the forward guidance. Jonathan, good morning.
Manus Cranny, good morning. And thank you, my friend, for everything. Appreciate it. Thank you very much. On our radar this morning, Ontario, Canada, raising prices on all power exported to Minnesota, Michigan and New York. The move part of retaliation against President Donald Trump's tariffs. The latest push from Canada, the latest tension between the two nations.
And it really points to what people didn't expect, which is the resentment that would set in and the fact that political leaders would have to show force against Donald Trump to really cater to their own populations. This idea that not only that, but they would have to come up with some sort of fiscal plan or some sort of political unity. I mean, it's helpful to have a common enemy, and that's essentially what President Trump is offering, a whole host of governments that he otherwise would like to see come down. But that's essentially what he's done.
Doug Ford, the premier, was on with Bloomberg last night. He was talking about Trump has created this chaos. He said Trump will single-handedly be the individual that brings on a recession. The jury's still out on that, by the way. And he's talking about the fact that this is not going to stop because there's patriotism now running wild in Canada. And you know what? You see that in the polls. Trump almost had it where we were about to usher in a conservative leader in Canada. But now the patriotism we're seeing, they're rallying behind Trudeau's party, which is now the party of Mark Carney.
Polyev must be fuming. 20-point lead for the Conservatives over the Liberals. What, 2 months ago? That change has just been humongous over the last 60 days or so. There is a meeting later on today, so just keep this in mind. 5 p.m. Eastern Time, a meeting between the Business Roundtable and the President of the United States. That's led by Cisco's Chuck Robbins. And sources are telling us here at Bloomberg that the group could include Wall Street bosses Jamie Dimon and Jane Fraser. This conversation at 5 p.m., I hope we get to see some of it, is going to be very important.
Up until now, there has been this placating type of approach when it comes to CEOs going down to Washington, D.C., having conversations with President Trump. What can we do for you? How can we rewrap some of our plans and goose them up a little bit and make them look like they're even better? How can you use us as an excuse of the dynamism of the American economy? The tone is going to be different. What do they ask for? And can President Trump give some clarity at a time where he says that he already has, and he has a plan? How does he give clarity without backtracking on some of the plan?
They want clarity, but part of his approach is to be uncertain because if he's negotiating, he wants to have that leverage over allies and foes. I want to see what the tone shifts from individuals like Jamie Dimon, who a month ago said, so far so good when it comes to Trump's use of tariffs. He then went on to say they do get people to the table, they do piss off allies, they're confusing and stuff like that, but they can have negative consequences. So first they were so far so good, but they could have negative consequences. Are we at that point where Jamie Dimon walks out of that meeting and says they do have negative consequences?
I wonder if Elon Musk will be in the room. Elon Musk saying that entitlement spending, including Social Security and Medicare, is next on the Doge chopping block. Musk arguing the federal programs are plagued by fraud. There was a really nice sit-down conversation between Elon Musk and the former NEC director, Larry Kudlow, just yesterday.
The issue with this, of course, is that, yes, Elon Musk is correct when you talk about what is the massive piece of pie when it comes to government spending. It's going to be entitlements. But this runs absolutely counter to what Donald Trump made in terms of promises on the campaign trail and in office. He will not go after Social Security and Medicare benefits. Elon Musk, though, First Buddy, is saying that's something he's looking at. So we need some clarity on that as well.
Is the president buying a Tesla today?
That's what he says, according to his Truth Social. Well, look, it was just after midnight, so I'm thinking he said this morning as in a few hours because he probably didn't go to bed yet, or it could be tomorrow. I'm just wondering if he's going to buy, the small, model,
he's
or is he going to buy a Cybertruck?
100% he'll drive it up.
Come on.
Of course, drive it onto the wall.
Golf cart? That would be very Trump.
That would be hysterical.
Drive it around the White House.
And then leave it there?
That would be cool. Let's talk about CPI. The data drops tomorrow. Get another read on the US consumer, a read on the labour market later on this morning as well when we get jolts. The Bank of America Institute releasing its latest consumer checkpoint survey. The team writing the following: the consumer is still demonstrating underlying forward momentum, though at a more measured pace. I'm pleased to say that giving us some time this morning is Holly O'Neill, the president of retail banking at Bank of America. Holly, welcome back to the programme. A warm welcome to Bloomberg Surveillance. We've heard from a few companies in the last 24 hours, from Delta Airlines, from American Airlines, that maybe the consumer was a bit softer in February. We're just wondering, Holly, whether you see anything of the same at all in your business.
So I think you had it right when you said continued forward momentum, but at a more measured pace. And in February, we saw a little softness mid-month in certain regions in Texas, on the East Coast. We really think driven by weather. And in most of those locations, it recovered by the end of the month. So when you look at the February spending data that we have, it was up month over month when you seasonally adjust it. So even though there was some mid-month disruptions with weather, we saw most locations recover from that.
Holly, on what, though? Recover in terms of spending on consumer discretionary, on groceries? I mean, we've been talking all morning about the airlines coming out and saying that they really haven't yet seen that recovery in some of the domestic travel spend. Is that really being focused in, say, buying food for families?
Sure. So overall spend recovered. So our total debit and credit card spend was up month over month, seasonally adjusted. So that includes everything. When you dig in underneath on the grocery front, grocery spending was up. And we actually, within those numbers, you saw value grocery spending up, premium grocery spending down a little bit. So overall groceries up, but you saw the consumer adjusting where they were spending their money.
So this goes to this question of, is this a head fake? Are people getting a little too carried away with the narrative that sentiment is deteriorating so rapidly that spending is falling off a cliff and that's going to stymie any kind of American exceptionalism? Would you push back against that and say, actually, what we see is just the same as what we saw before, which is a moderating trend, people looking for value, but otherwise a consumer that's still pretty healthy?
That's right, a moderating trend. And you really do have to separate what sentiment says versus what consumers are actually doing. And so that spend data, the grocery trends that we talked about, the overall spend, that is what consumers are actually doing. And we do at times see a difference in sentiment and their actual behavior. And I think that's very important. So again, continued forward momentum, but at a more measured pace for the consumer. We did not see spend fall off a cliff, as you said.
We've also talked about the fact that delinquencies on credit cards have been creeping higher. We have seen some signs of distress in auto loans. I'm just wondering where fact meets fiction, right? Where stories have gotten carried away from each other, from themselves, versus any kind of true warning signs that you're seeing in any of the trends that you monitor.
So from a credit perspective, we're seeing a very normalized environment at Bank of America. And in fact, we're seeing delinquencies, somewhat stabilize and are expecting them to come down as the year goes forward. So we're not seeing any unusual patterns there. And I would call it a very normalized credit environment from what we're seeing with our clients.
You mentioned the potential tariff impact in your report. What sectors are you seeing that bleed into this potential increase in prices and then potentially what it might be harder for consumers?
So we'll look at the consumer as a whole, right? And we'll look at high-income consumers, we'll look at low-income consumers and watch what their patterns are. But as we talked about with the groceries, consumers do self-regulate with shifting prices, and I would expect nothing different no matter what tariff environment comes through. So we'll watch the consumers really closely as to how they adjust their spending patterns if prices were to increase.
Do you see any policies out of Washington hitting consumers right now besides trade?
We are not. I mean, again, across the board, we're seeing very normalized, good momentum with the consumer overall. So we're not seeing anything underneath from Washington come through now.
Holly, just to finish on what's been happening with interest rates have stayed much higher for longer at the Federal Reserve, but rates at the long end, something that this administration has celebrated, have started to move lower, which is important for mortgages. What are you seeing in terms of credit access, and are consumers trying to step up, or are they holding back?
I would say consumers continue to borrow. Consumers continue to borrow at a normalized rate, and we see that in our credit card data. So average borrowing from our credit card borrowers is slightly above where it was pre-pandemic. So they still have access to credit. I think from a mortgage perspective, we haven't quite seen the demand really flood back into the market. We're still seeing purchase volume, but again, because of the rate environment, that refi volume is certainly at the lower end. But that's something that we would expect to come back as the rates change.
Holly, appreciate it. This was an important update on a day where a lot of people are concerned about the consumer. Holly O'Neill there of Bank of America, the president of retail banking. What we've seen so far then from the companies, the likes of Delta, the likes of American Airlines, seeing a softer consumer than anticipated only a few months ago. What we've seen in the surveys is things really soften up. Saw that from the New York Fed just yesterday. What you're hearing from Bank of America, which has literally millions of bank accounts for retail accounts in the United States of America, is yes, things have moderated, but you still have that forward momentum.
They still saw an increase that was significant in travel spending, which I thought was interesting when I looked at their recent study, because it just highlights that it's not as clean a story as it may seem. You talked, though, about the New York Fed survey yesterday. Mean unemployment expectations jumped 5.4 percentage points to 39.4%, its highest reading since September 2023. The sentiment is concerning for people because it's happening at all ends. At the same time, right now, you're not seeing it in the hard data.
Not yet, and maybe we will in the months still to come. Equity futures right now on the S&P, positive by 0.5%, with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Western security officials say Russian President Vladimir Putin has no intention to compromise on land, peacekeepers, and Ukraine's neutrality in any peace talks. Those officials said that Putin has made a maximalist list of demands ahead of negotiations and is prepared to continue fighting if his goals aren't met. Greenland is heading to the polls in a general election that will determine the country's path to independence from Denmark. All leading parties favor sovereignty, but the winner will get to define how and when Greenland becomes its own nation and which countries it may align itself with once that happens. Elsewhere, Apple is preparing a major software overhaul. Bloomberg has learned that Apple is planning to transform the interface of the iPhone, iPad, and Mac, aiming to make its operating systems more consistent and simplify navigation. The revamp will be unveiled at Apple's Worldwide Developers Conference in June. And that's your brief, John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the flight to safety.
I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some.
Up next on the program, Kelsey Berro of JP Morgan Asset Management. Live from New York, you're watching Bloomberg Surveillance. The airlines in focus this morning. Check out these two names, both American and Delta. Delta is down by 7. It was a whole lot worse than that. It was down by double digits earlier this morning after cutting its guidance yesterday for Q1, slashing the outlook for the first quarter. Who was next? American Airlines was next. That stock is down by 3.6%. Getting an update also from Dick's Sporting Goods. The airlines are telling us that the consumer started to pull back in the middle of February, and businesses did too. The outlook at Dick's in focus here, Lisa, the stock down by close to 4%.
A similar type of tone as the airlines. And there was a question, how much is the airline story idiosyncratic because of safety concerns? Dick's Sporting Goods also gives a downbeat outlook, talking about, quote, the dynamic macroeconomic environment as leading to some of the concerns that they have. You're looking at some sort of earnings per share being as low as $13.80 for the upcoming year versus the expectation of $14.23.
Why don't they just say it? Why do they have to say the dynamic macro environment?
Macroeconomic environment.
Why don't they just say policy?
Well, and actually we heard directly that from Ed Bastian. I think a lot of pause. Take a step back. This is very quickly moving, and we have gone from a scenario, I can't believe you're making me justify this, where companies were concerned about invoking the ire of the White House, to now trying to give a slight suggestion that maybe this is problematic.
And maybe we get an update on that slight suggestion at 5 p.m. Eastern Time. Later on this afternoon, the Business Roundtable sitting down with the President of the United States. Under surveillance this morning, the flight to safety.
I think you've been in a scenario right now where you're in peak uncertainty. And what that's done is created a desire for safe haven assets, long duration fixed income, defensive U.S. equities. And in that environment, you've seen non-U.S. do well as the dollar has softened some. That's great because the world's looking at a period of time right now where you have kind of debt spending internationally and some austerity or restructuring in the U.S.
So here's the latest this morning. U.S. Treasuries rallying yesterday as the S&P 500 nears correction territory. Kelsey Berro of J.P. Morgan writing, amid the uncertainty, one detail is clear. An allocation to high-quality fixed income is once again serving as a diversifying ballast in investor portfolios. Kelsey joins us now for more. Kelsey, good morning. Good to see you.
Good morning.
Let's pick up on what Steve Chevron said there at the end. Maybe some austerity in America, and I stress maybe. And you put that up against perhaps a real expansion of the fiscal deficit over in places like Germany. What does that mean for treasuries in an international bond market?
Yeah, so I think that you've hit on a really key point. We've been very focused on the U.S., what's happening in the White House, but there are seismic shifts happening outside of the U.S. right now. And the shift in Europe towards defense spending and towards infrastructure spending is really an important shift that we're seeing. And while we're talking about in the U.S. that bonds are serving as a diversifying safe haven, so while stocks are going down, bond prices, you have U.S. Treasuries, agency mortgages, investment grade credit, all up in price yesterday. In Germany, you have essentially the opposite, which is bonds have been hit massively. Bond yields are up, but stocks are up in Europe too. One of the biggest trades that's been in place for at least a year has been the investment of foreign investors in U.S. equities on an unhedged basis, right? They wanted the U.S. equities and they wanted it unhedged because nothing's ever going to happen to the dollar, right? That, I think, is the biggest trade that is in the process of being reevaluated right now.
You think we're unwinding that big dollar long we've built up over the last several years?
That is what it appears. It's not going to be a straight line, right? But I do think that what has been underestimated is not what the U.S. is doing, because that's been out there. Trump's been talking about tariffs. Trump's been talking about layoffs. What's been underestimated is the response from the rest of the world. We knew they would respond. The magnitude of the response has been the surprise.
There's a real question embedded in this observation about the shift in the balance of dollars and the dollar long, which is if money is moving away from the United States, do long-term treasuries offer the same kind of ballast, or will there not be the same degree of demand for them because some of that money is diverted elsewhere, say to Germany?
So I think that we can differentiate a bit between the equity markets and the dollar trade and the bond trade. Typically, you think about them together, but what we've seen over the past few weeks is you can have periods where the treasury market is getting a bid, long-term yields are falling, and the dollar is softening modestly. It sounds like a bit of a paradox, but I do think it's something that can continue to occur. One thing that will be on investors' minds as we move forward is the deficit trajectory, right, in the two places. In Europe, we're seeing for the first time Germany is considering a deficit, considering more deficits as an advantage to them. At the same time, the U.S. is considering the fact that deficits are not our friend anymore, and we need to be managing them much more closely. As long as those two, that sentiment continues, I think that you can continue to see the support in long-end treasuries. And on the other hand, I would expect Europe, Germany to continue to underperform.
I would love you to have a debate with Ashok Bhatia of Neuberger Berman, who was on the show yesterday. At some point, I would love to witness you guys have a discussion about this. He was saying he actually is getting a little bit more bearish on long-term treasuries. What he sees is this concern that even as people price in Federal Reserve rate cuts, that stickiness in inflation and that real kind of floor under how far the Fed can go and ongoing deficit concerns that are not going to get fixed by simply cutting on the edges. It will take something more sustainable, is going to really create a problem longer term for the United States and for the Federal Reserve. Why do you disagree with that the term premium is just going to be structurally higher in the United States?
Well, I think the term premium already is structurally higher, right? So if you're a longer term investor, if you are, looking at the market over a 5 to 10 year horizon, you're already observing that term premium in the U.S. is substantially higher. Yields are substantially higher than they were before. So I think that story is already essentially in the price. And what we're looking at now is that there's quite a bit of demand at these yield levels, particularly when you have a Fed that is maintaining an easing bias. Yes, inflation has been a bit stickier than before, but it's our view that ultimately what is going to get the Fed moving more aggressively in terms of rate cuts is if we start to see the weakness translate into weaker labor market data.
High yield spreads wider yesterday by almost 20 basis points, back through 300. Is that a buy yet? What are you looking for?
So it is interesting. This goes back to this kind of question of, is it the spread move that people care about or the price move? So spread buyers are saying, great, okay, we've had a bit of a backup. Maybe this is an opportunity to get in. On a price basis, most of the high quality part of the high yield index those bonds have not really moved down in price very much because the yield movement has offset the spread widening. So I think you could view that in two ways. One, maybe there's a little bit more pain to come, but also I would say it's really credit towards the strong fundamental starting point for investment grade and high yield bonds in this market. And I don't think we shouldn't lose sight of that. Coming into this year, growth was very strong. Defaults continue to remain very low. Margins for companies were at the higher end of their ranges. So companies are probably as best placed as they possibly can be for the difficult times ahead.
Kelsey, appreciate it. Kelsey Berro there of JP Morgan Asset Management. Corporate America still resilient. It's a message we've heard over the last number of years.
Corporate America that borrowed bonds a while ago and then locked in financing costs in the high yield bond market.
Everyone else, if you haven't done that, might be a problem. Coming up, Matt Miskin of John Hancock, Ben Kallo of Baird, Lindsay Piegza of Stifel, and Lindsay Rosner of Goldman Sachs. The third hour of Bloomberg Surveillance up next.
The risks are rising. This risk of something deeper than a 10% drawdown, that is rising.
The markets will come to recognize that this volatility is here to stay.
You have to have some risk aversion in the portfolio.
As an investor, if you wanted to get defensive ahead of this, you had to do it 2 months ago, and none of us did.
There's something beyond just trade that's driving markets, and I think it's sort of a deterioration in the data.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now with equity futures near session highs, positive by 0.5% on the S&P 500. The next stop for this market, just in terms of the economic data, about 2 hours away. In 2 hours' time, the JOLTS job openings read. Job openings in the United States of America, another read on the labour market worth looking at. Then later on this afternoon at about 5 p.m., The Business Roundtable, led by Chuck Robbins of Cisco, sitting down with the President of the United States, included in that meeting, reportedly, potentially, Jamie Dimon of JP Morgan, Jane Fraser of Citi, coming at a time when business confidence, and small business confidence specifically, Lisa, is just starting to soften.
We saw it roll over to the greatest degree going back 4 months in the NFIB Small Business Survey earlier this morning. We're hearing from a host of different companies that they are downgrading their outlooks in the near term because of consumer uncertainty. We're hearing that across the board, across industries. At the same time, Holly O'Neill really presenting the opposite view, which is consumers are still spending. Watch what they do, not what they say, and that has been somewhat different.
There is still that forward momentum. Are we losing some of that forward momentum, though, for consumers? So let's go to the airlines. We've heard from Delta, we've heard from American Airlines in the last 24 hours, both of which have cut their outlook for Q1. Ed Bastian of Delta suggesting that maybe some of these issues could be transitory. But what does it mean for summer travel? This is what we're hearing from Delta executives. They're speaking at a JP Morgan industry conference just moments ago, planning to slow capacity growth plans for both spring and summer. That speaks volumes.
It speaks volumes, especially, and I keep going back to this, in January, they said that the supply-demand dynamic was as good as they've ever seen it. Suddenly now, they are cutting capacity in order to keep prices up and keep their profitability up. We're seeing similar tones across the airlines. We heard from American Airlines. We heard from JetBlue. We heard from Southwest, now charging for you to check your bags for the first time in their history. I mean, all of these ways to really drum up revenue. Well, I mean, look, I'm just saying, you know, it's always really fun to fly, but it's going to get even more fun.
Take a beat? I think we should take a beat.
Okay, go ahead.
They've got this totally back to front at Southwest.
You're correct on this.
The most disruptive part of flying right now is the boarding process because the overhead cabins are full of luggage and people have to put their luggage in the hold. The convenience is the cabin, not the hold. So charging people for the hold is not the issue at play here. Charge people for the cabin, give the hold for free. You'll make the money because a lot of people want the convenience and you'll open up the space and hopefully you'll improve the experience of flyers in the United States of America. Why is that so difficult to get your head around?
You know, it would also improve probably some of the employee satisfaction who are not trying to break up fights for people to get on into the plane first. You know, the whole idea of gate lice, remember that? People who try to pretend that they have a higher status, they can get on first. They wouldn't care if they could just pay to check their...
some regulation that I don't know about that prevents them from doing that because it just makes so much sense. Why not do it?
Well, it's also opening up now, potentially this void for other airlines to fill. Delta now saying that Southwest bag fee change puts customers up for grabs because they're saying that this might mean customers are saying, look, we'll go elsewhere if we're going to have to pay for it. But I totally agree with you. You want to pay for the convenience. And also, it just goes to show that more people want to actually bring their luggage with them because when they're at capacity, they just take your bag for free because they have no choice.
Want to make it smoother, reduce the friction. That's what it should all be about. Anyway, there's your tangent. Equities right now in the S&P positive by 0.5%. We begin this hour with stocks looking to rebound from their biggest one-day loss of the year. Matt Miskin of John Hancock writing, there is an equity risk being priced into the US that is going in the opposite direction in non-US. We struggle to see such a divide in global growth being sustainable. Matt joins us now for more. Matt, welcome to the program, sir. Let's talk about that. Why do you believe that some of these trends are unsustainable?
Because at the end of the day, John, we're all together on the same economic cycle. So global growth is actually moderating in our view off of a pretty good level in 2024. If this is a macro regime shift, and it's almost like we went into a reacceleration into an air pocket. So we're feeling that turbulence. All of a sudden, the U.S. economy is slowing down a bit here. Might be the weather. You know, we might have to do a little Milli Vanilli and blame it on the rain. But at the end of the day, we're feeling an air pocket. If the macro regime is going back to slower growth, we're not going to likely see a lower quality cyclical rotation out of much of these non-U.S. equities.
So, Matt, you're not chasing Europe here. You're not chasing China.
That's right. I mean, the momentum has been terrific, and it is seen just massive gains year to date. But what we're seeing is really reruns that we saw in the United States. So from Europe right now, we're getting election euphoria. Everything's going to change. It's going to be much better. And European financials have skyrocketed. I can't stop watching them day to day because they're the new meme stock. But after an election, a lot of times there's this cooling after post-honeymoon period, which actually the United States has seen a little bit here. That may happen in Europe. In China right now, they're going after the AI trade. We've seen this trade before in the U.S. And so a lot of these we think are going to be shorter term phenomenon. We'd be tactical, try to trim into some strength, redeploy capital. We're actually looking at higher quality bonds and actually credit relative to equities. So you can dial back your equities and go in. You were just talking about high yield bonds yielding around 7.5%. Get income now instead of price appreciation. Income's likely to be a bigger driver of total return going forward. That's what we're focused on.
For a second, Matt, I thought you were going to come out and say, buy U.S. stocks, buy the weakness, and instead you say, buy bonds, which is not exactly raging optimism, and talking about high-quality bonds at that. Are you talking about, if it's not necessarily the golden spot in Europe or in China, that we're facing a global slowdown where the United States and duration is really going to be the haven that will protect you at a time where other areas might be getting a sugar high right now?
It's exactly right, Lisa. And what we're seeing is that certain markets are repricing, certain markets aren't. And as a global multi-asset investor, this is what's phenomenal for us, because we're looking around and we're saying, what is pricing in risk? What isn't? And actually, the 10-year still at about 420 to us is not pricing in that much bad news. I mean, you got to rewind about 5 months, and pre-Fed cuts, the 10-year was 360. So you still have a lot of cushion of yield potential that could be evaporated, frankly, if the bond market starts pricing in worse economic data. And then globally, yes, there's capital that is flying around the world looking for the fastest momentum trade. The U.S. momentum factor has hit a wall, and that has yet to happen on a global basis. But we actually don't. The U.S. is actually holding up okay in our view right now. It's just slower growth. It's not the end of the world growth. And it's odd to us that some of these high quality stocks are the ones selling off the most. Actually, we think there's going to be value in some of these tech names that have sold off here, whereas other parts of the market have gotten more expensive and they're lower quality equities.
What are you waiting for, Matt? I mean, I ask this because a lot of people are saying, okay, this potentially could be a buy the dip moment. If you liked it 10 days ago, why not like it even more on sale? It seems like there is a level of uncertainty that's making it difficult for people to say with conviction that we're not in some sort of paradigm shift, that we're not seeing a rejiggering of the global dynamism and, frankly, a releveraging of Europe while you still have a pretty big deficit in the United States. What gives you the confidence that there will be that upswing, that there will be that sense that the U.S. is still exceptional?
So we're watching high yield spreads, and as you all have already talked about, they're over 300 basis points. They're going in the wrong direction, so that is making us actually less optimistic in terms of this, potential reacceleration of the economy. But initial jobless claims is another thing we're watching, and they're 220,000. They came back after the prior week. But what we're doing right now is we're bracing, in essence, for the potential slowdown around the government employment picture. This last jobs report, we didn't think was that bad. But the question is, okay, well, is the next one going to be weaker? And are we going to see the Challenger report was actually the biggest shock of last week, showing that the layoff announcements were ticking up. That usually leads initial jobless claims. And then again, high yield spreads. So we are more defensive in the equity positioning. We do have some high quality, but we have quality values, things like healthcare, utilities, dividend paying stocks, high quality balance sheets. Those have sold off a bit, but they've held in mid cap, for example, and some of the high quality is holding up the best year to date. And then international, it looks like the world, they're trading on another planet. And in our view, that's going to come together. We wouldn't chase that. We still like quality, but again, income is going to be a better return driver after so much return out of equities. We got to find different asset classes to work into the portfolio. Credit and high quality bonds are great opportunities to us.
Matt, I hear what you're saying in terms of equity risk being priced into the U.S. and it's basically going in the opposite direction everywhere else in the world. Does that change on April 2nd?
Perhaps. I mean, it can change on a dime, frankly, but right now you could just see it in the commodity trading advisor or kind of the momentum traders, global macro traders. It can change quickly, and we just want to be careful here chasing that, and so much right now is politically driven. This year, 2025, almost everything has been political, influencing the markets. And in our view, that is a shorter term phenomenon. It's not investable. We actually don't use politics in investing. I know it sounds crazy because given everything that's going on, but you really want to focus on the earnings trends. The best earnings in the world still is in the United States. We still like the U.S. vis-a-vis other parts of the world. And actually, for once in a while, they're getting cheaper. that might actually cause a relative opportunity versus a lot of other equities elsewhere.
Matt, you say you don't use politics, but we're talking about policy. The Trump administration is talking about a global realignment when it comes to trade and also changing the way basically the U.S. economy works, trying to reprivatize and also make sure jobs are going more into the private sector. That's not politics. This is policy. You have to start baking some of this in, no?
Annmarie, I'd love to agree with you on that one, but the policy can change on a dime too. Yesterday we could have tariffs, today we can't. Next day it could be tariffs, the other day it can. And if you're trying to make a decision on 12 to 18 months or 3 to 5 years for clients, investor portfolios on tariffs that could be here tomorrow or gone the next day, it's just going to drive.
Just to jump in, if you can acknowledge that that's going to be a feature of the next several years, wouldn't you also have to acknowledge that the multiple that people will be willing to pay for some of these names will be lower than it otherwise would be if we had clarity on policy?
I hear you, John, but at the end of the day, NVIDIA or some of these huge tech giants, they've been growing earnings. That wasn't because of fiscal policy. The real earnings trends are because of competitive, it goes back to like SWOT analysis of business school, or it goes back to, kind of the productivity or the executing of the business. We're investing in companies, not countries. It's about the stocks, not the economy. You're not investing on GDP. You're not investing GDP. You're investing on the stocks. And I think that's a big differentiation right now. Right now, everything's getting turned around really fast based on political headlines. You're going to get yourself turned around into a pretzel on that. You want to really focus on the fundamentals. And right now, they're not that bad, but they are diminishing. If that macro regime is changing, you want to actually move up in quality, focus more on income. And we're trying to keep it simple. And that's where we would position.
Sounds like you're buying NVIDIA.
Not go that far, John. We don't talk about it.
That's right. That's right.
We like quality.
That's right. That's right. Just as you're in the flow, just setting your trip up. Matt, appreciate it. Thank you, sir. Matt Miskin of John Hancock Investment Management. Equities right now in the S&P positive by a little more than 0.1%. A small bounce this morning. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Billionaire presidential advisor Elon Musk is calling for cuts to entitlement spending, including Social Security and Medicaid, arguing that the federal programs are plagued by fraud. Speaking to Fox Business, Musk said most of the federal spending is entitlements, so that's the big one to eliminate. However, many Republicans have been adamant that entitlement benefits will not be part of DOGE cuts. Shares of Dick's Sporting Goods falling in the pre-market 5.2%. The sporting goods retailer reported sales and profit that beat analyst estimates, but it did issue a disappointing outlook for the fiscal year. Dick's CEO has been working to invest the company's physical store network and upgrade its e-commerce capabilities. And Mr. Beast's biggest moneymaker is not YouTube, it's chocolate. Jimmy Donaldson's Feastables chocolate business generated about $250 million in sales last year, with a more than $20 million in profit. His media business lost almost $80 million. Sources tell Bloomberg that Beast Industries is looking to raise a couple $100 million to expand its existing divisions. And that's your brief, John.
Danny, thank you. More from Danny later this hour. Up next on the programme, the Morning Calls Plus, Ben Kallo of Baird on a big move lower in Tesla. That's next. This is Bloomberg. Equity futures here just about positive, up by 0.1% on the S&P, up by 0.2 on the Nasdaq 100. You're opening about 1 hour and 13 minutes away. Let's get you some morning calls. First up, Barclays lowering its price target on Delta to 80, anticipating softer demand. That stock is down by 7% this morning. Your second call from Stifel, lowering its price target on Oracle to 150, expecting limited multiple expansion. That name is down by 2.3%. And finally, CFRA upgrading Amazon to strong buy, saying the company is more recession resilient than its peers. Stock just a little bit softer. We're down 0.1% so far this morning. Let's turn to Tesla. Shares looking to bounce back after their biggest one-day drop since 2020. The stock down nearly 45% so far this year, wiping out its gains since President Trump's election win back in November. Ben Kallo of Baird writing, we continue to view Tesla as a core holding long-term and see the company as the leader in real-world AI. but a bearish near term. Ben joins us now for more. Ben, welcome back to the programme, sir. You're one of the best, so looking forward to this conversation. Walk me through, just from your standpoint, what's leading this stock lower? Is it something bigger than just the name itself, or is it Tesla specific?
It's market is the backdrop, but Tesla specific. It's delivery numbers. It's as simple as that. For Q1, the stock can't go up until the consensus numbers come down because there's this narrative that Musk is destroying demand out there. Whether that's right or wrong, they're doing a Model Y refresh across all 4 factories. And so a Model Y typically has 300,000 deliveries in a quarter. So let's just take out 2 months of that. So 200,000 cars that aren't being produced or just now being produced. And that's going to be compounded with all the backdrop of protests and all the bad stuff going on with Tesla. And it's going to extend that narrative around demand.
But Ben, deliveries have never really mattered, right? I mean, it doesn't seem to matter how much they sell or how much they don't sell. It's always about this faith in longer-term robo-taxis and autonomous driving. Has that belief shifted? Has there been a narrative vibe shift among retail investors that could mean a longer-lasting dip?
I think so. I think that over time we've seen, the lens where Tesla's value to be longer at some points, and when things get bad, it tends to, refocus very short term, and that's where we are right now, very short term focus. And I think that when we get a delivery number that's worse than people are expecting, it's going to be carrying on that narrative of demand being bad because of demand destruction, and that affects the long term story.
Yesterday, Elon Musk was asked on Fox News about how he was running his other businesses while he was engaged in right-sizing the government. And he said, with great difficulty. At what point do people get concerned about the fact that their CEO is distracted and doesn't really have time to manage the company, forget day to day, but even week to week?
Well, it's a good question. It's come up a lot because of SpaceX and his other businesses that he has. Now that he's at Doge and he's spending his time in Washington, D.C., I think it's harder to defend what he's doing on a day-to-day basis and how much he's being involved in. And you have pundits out there, people that would normally be like on his side saying, like, hey, send me 5 bullet points of what you've done. I'm not saying that's right or wrong, but when you have someone that is well known in the media saying, hey, why don't you send me 5 bullets about what you've done at Tesla lately? That, raises eyebrows.
Ben, yesterday we had, or last night, the president come out and in a truth post say he's going to go out and buy a Tesla in the morning. He talked about the fact that Elon's, quote, baby is under attack and people want to do harm to Elon. If Trump comes out and buy a Tesla, is that bullish or bearish for the shares?
I think that it's good that he supports, and I agree that Musk is an important person in the United States globally, but I think there's a lot of people that are indifferent to Musk at best. And one point that I'd like to make when we're talking about demand is if we read about people's cars getting keyed or in worst case scenarios set on fire, if I'm indifferent or even a Musk supporter, I might pause before I go buy a Tesla. But our call is not that. Our call is that numbers are too high because of production issues in Q1, but that's going to extend the narrative of demand destruction in longer term.
But it's not just demand destruction potentially in the United States. When it comes to Musk and his political involvement with the president and Doge, we're also seeing this in Germany and people pushing back because his support for far-right German party. How do you pinpoint potential political erosion of the shares?
It's difficult, and that's where uncertainty is, and that's why the stock can't go up until, I hate to keep repeating myself, until numbers come down on the street, because it's going to continue that narrative. But I think that, Europe counts for about 25% of sales. I think the demand destruction is actually happening there versus the United States. Now, those numbers get kind of iffy because they are having production issues right now. But I think in Europe, people take this a lot more seriously when they're buying a car than Uber driver, in New York City.
Potentially more than political threats or political boycotts is the idea of China competition and the fact that BYD has overtaken Tesla as by far the biggest seller of electric vehicles in China. And you have this increasing production in that nation as well as lower costs. At what point does that become a real headwind that becomes harder and harder to ignore, especially with all of the other challenges that are facing this name?
Anecdotally, I was in Europe for 2 weeks visiting clients over the last 2 weeks ago. And, I see BYD stores and, talking to clients. Someone brought up a good point. Like a year ago, no one would have bought a Chinese car. Now with the alternative being a Tesla and Musk, this was their opinion, not mine. That it's an easier sale for a BYD. But I think it just compounds, the uncertainty in the stock right now.
It's certainly a tricky moment for the stock. Ben, appreciate your time, as always. Ben Kallo there of Baird. The stock this morning attempted to bounce back from the big one-day loss yesterday, the biggest one-day loss since 2020. If you just go to the analyst community this morning, check out the ANR page on a Bloomberg terminal if you have access. The average 12-month price target right now is 362. So you're talking about 60% upside from where we closed yesterday. And if you ask those analysts why are they so bullish, they won't talk about car sales. And this is the tricky moment with Tesla, to be honest with you, because there are market regimes where auto sales and deliveries drive the stock. There are other times when it really doesn't at all. You're talking about the future, full self-driving, what's going to happen with AI, that big futuristic stuff. That's going to be what underpins a lot of those really bullish calls.
This is a storytelling market. This is a storytelling market that really points to the idea of a future where we don't have to drive and we can send our kids in cars with no drivers and they can get anywhere that they want safely and in an orchestrated manner. And the chief storyteller is not available. And that, I think, is important. And the fact that the chief storyteller is now a polarizing figure in American politics makes this a much more difficult story for a lot of people to buy into.
Market backdrop doesn't help. People don't want to hear nice stories. They want to see evidence. They want to see the real deal. They want to see the data. And in moments like this is why I think deliveries matter that much more.
Yeah, it also matters what point we're coming from. I mean, we're seeing a 55% retracement in the shares after a huge run up after the election, giving up all of those gains. So are we back to where we were before, or is this the beginning of something more protracted? And that's really the ultimate question.
Tesla this morning bouncing back by just 1% in the pre-market. Up next on the program, we'll catch up with Lindsay Piegza of Stifel. We'll get her thoughts on what's happening with the economy, the latest small business confidence read, and what we're hearing from the airlines. We'll speak to Lindsay about that. Then Rosner of Goldman Sachs as we look ahead to the economic data through the rest of this week, CPI tomorrow, and some of the moves we're seeing in fixed income. From New York City, this is Bloomberg. Equity futures on the S&P positive by 0.25%. The open and bound about 60 minutes away. With your morning movers, here's Danny Berger. Hey, Danny.
Hey, John. This morning, I had a little bit of an airline special for you. I know we're also just getting some breaking lines from United about them seeing a drop in government-related travel. Delta, though, kicking it off with that. This really started it off yesterday with their earnings cutting basically in half their first quarter expectation. Delta shares falling some 4.33%. It's the worst of all worlds. It is a consumer that they say is less willing to spend because of macro uncertainty. That's hurting domestic travel, plus the mid-air collision of American Air and a crash landing for Delta. Speaking of American, another airline that we heard from this morning, a very similar picture, seeing a wider loss for the first fiscal quarter. Those losses aren't as bad. I should say all these airlines are starting to pare some of the worst of their losses. American Air down about 1%. Now, Southwest, also a similar warning from them. Their forecast is going to look weaker with that demand, but a difference in fortune for the shares. Those shares up 10.33%. And John, I know you have some feelings about this one. Part of the reason that the shares are up is because they're doing a change of strategy. No longer will you get free checked bags. Your first and your second one, you're going to have a fee paid unless you're part of their loyalty program or have a business flight. All of this part of Elliott, some of the Elliott management changes that's come in. So those shares up nearly 10%, John.
Danny, thank you. Appreciate it. That's the latest on the airline front. Just want to throw in this additional headline. Danny mentioned United Airlines. If you're just joining us, welcome. This is quite a headline. saying it's seen a 50% drop in government-related travel. That's the headline just dropping from United.
I'm not surprised about this at all because anecdotally I did hear potentially some departments and agencies were pulling back on who they were letting go travel to conferences or meet people around the country or internationally. So when you see this, I'm really not surprised given the Doge effect and how they want to really rein in spending at these agencies and make agencies more efficient. But 50%, that's huge. That's half of government travel.
Yeah, it's government travel and all related. And we keep talking about the idea of what kind of contractors and contract work is also going to be put on ice as they wait for that. And just to give you some commentary from the JP Morgan Airline Conference, Ed Bastian, Delta CEO, saying the first quarter has been a parade of horribles. That has been his discussion point for the airline industry.
So how much of this, and this is the key challenge, I think, how much of this was about the accidents we've seen, the flight safety events of the last several months? How much of it is truly about a slowdown in the consumer and business-related stories connected to what we're seeing with the Doge effort down in Washington?
Look, we can't say with any precision, but what we can say is it's not just the airline industry that's giving the same type of sentiment shift. We're hearing from Dick's Sporting Goods. We heard from Kohl's. We've heard from Walmart. We've heard from a whole host of other companies. At a certain point, it's no longer anecdotes when you have a holistic tone shift.
Get more data later on this morning, about 90 minutes away. You'll get Jolt's job openings at 10 a.m. Eastern Time. Tomorrow, you'll get CPI. The day after, you'll get PPI. Mike McKee, our economics and policy correspondent, joins us now for more. Mike McKee, what are you looking for in that data later?
Well, we're hoping not to see a parade of horribles in the data this week. Jolts comes in with supposedly more job openings, but it's kind of irrelevant at this point, given the fact that people aren't really hiring that much, according to what they're telling officials at the Fed and other places. So look at the quit rate. Let's see what people think about their ability to get a new job. And, of course, CPI, everybody's going to be watching to see whether inflation progress continues or goes the other way, because we've gotten some not so great news this morning. We were talking in the 7 o'clock hour about the NFIB survey. There's also the New York Fed survey from yesterday showing the highest number of people expecting worse financial conditions in the next year in 15 months. And the share expecting higher unemployment is at its highest since 2023. That NFIB survey, as we showed you earlier, the second highest level ever for their uncertainty index, and a 10-point drop in small business confidence. So people are looking at the data, they're looking at the headlines out of Washington, and they're not feeling really great. I'll leave you with one chart here that might be important for the viewers right now. This is the New York Fed's question about what do you think is going to happen to stock prices? Kind of speaks for itself.
Not a pretty picture, that's for sure. Mike McKee, thank you, sir. Appreciate it. Here's the take from Lindsay Piegza of Stifel, running in and weighing in on the U.S. economic slowdown, saying the following. The clear rise in hiring hesitancy has some investors raising the probability of a downturn or even a domestic recession and increasing bets of further Fed policy relief sooner rather than later. Lindsay, I'm pleased to say, joins us now for more. So, Lindsay, let's talk about that. We have seen a major sentiment shift. The soft data, the survey data, has cratered in some places. Lindsay, when you see those kind of moves this quickly, is it inevitable? Is it even avoidable? Do you expect to see it in the hard data?
Well, it's not necessarily inevitable. What we're seeing right now is anxiety over the uncertainty of the realized impact of policy. Now, this was a large campaign promise in terms of the international tariffs in particular. So businesses we saw responding in anticipation at the start of the year, building up inventories, moving to the sideline, curtailing investment and employment plans. From a consumer standpoint, we saw consumers pull back. Again, all of this uncertainty really hitting the pause button for both businesses and consumers. But it will take a few months to see how these policies pan out and the actual impact on prices, on relationships with international providers. And at that point, we'll be able to mesh between near-term uncertainty and longer-run realized impact on the economy.
And Lindsay, we kind of got a reality check from Holly O'Neill of Bank of America earlier this morning, where she said consumers are still spending. I mean, they might not be spending as much on flights, but they're still spending, and it's a gradual slowing, but it's not some sort of catastrophic falling off a cliff in terms of what they're seeing in credit cards. And one thing that we keep thinking about is the economy moves pretty slowly. it takes a long time to really hammer an economy that otherwise has quite a bit of momentum. How quickly could we see it really show up in some of the hard data in a way that could be concerning? Or realistically, is the U.S. still a behemoth that is moving pretty slowly and still has quite a bit of momentum?
Well, when we look at the consumer, we did see a pullback at the start of the year. So we've already seen the hard data reflect the uncertainty in part of the consumer. That being said, it has been a second derivative decline, meaning a slower pace of still positive expenditures. So consumers are still out in the marketplace buying goods and services, but they're doing so at a noticeably reduced pace. That being said, we're also looking at how the consumer is affording these purchases, and they are increasingly reliant on buy now, pay later options, ramping up credit card usage with outstanding balances over $1.2 trillion. However, when we put that in perspective of the overall household balance sheet, we still see that the ratio of debt payments relative to disposable income is at a multi-decade low, or at least near a multi-decade low, suggesting there's still a good amount of spending and borrowing power left on part of the consumer to continue to support at least positive growth. Maybe not a robust economy, but if the consumer could gain some confidence and be willing to continue to move into the marketplace, I think the economy could maintain this positive pace of about 1.5% to 2%. But it all comes back to instilling that confidence back into the consumer, not necessarily the ability for the consumer to continue to spend.
This is kind of a mind-spinning moment, Lindsay, and I keep thinking about how soft data and anecdotes are going to be more important right now than the hard data that is going to be backward-looking. The fact that people are looking at the University of Michigan sentiment survey more than JOLTS or even initial jobless claims, because maybe that'll give them an edge onto what's to come. How much can we lean on soft data that has been messy and non-correlated with what people end up doing quite often?
Well, that's exactly it. Consumers often say one thing and do the exact opposite. And so while we are hearing from consumers that there is this anxiety and amid this massive amount of uncertainty, again, consumers are somewhat pulling back, but nominally this is a still positive pace of expenditures. And as long as the consumer, the backbone of the U.S. economy, is continuing to spend right now at an average 3% pace, that's still very indicative of a top-line GDP pace, holding all other variables constant, of about 2%. So again, the economy is still on relatively solid footing, but I think what we're seeing in the sentiment numbers, what we're seeing in the NFIB, what we're seeing from some of these anecdotal reports is this massive amount of uncertainty and this unknown from all of these fiscal policies coming down the pipeline, and a big question mark of how is this going to impact the economy as we look out to the second half of the year.
Lindsay, a week tomorrow, Federal Reserve time, a meeting with Chairman Powell, a news conference, new forecast. How eventful will March 19th be?
Well, I think it is going to be eventful, not necessarily from a policy standpoint. We do widely expect the Fed to remain on the sidelines. However, from a communications standpoint, we want to see where the Fed is falling in terms of are they erring on the side of the economy is still positive and thus they're going to continue to remain on the sideline waiting for the data to evolve, or are they starting to identify some of these signs of weakness, suggesting that they're gearing up to reignite some of this further policy relief that the market seems to be bracing for? So it's really going to come down to that communication, that message from Powell and from the FOMC statement.
Lindsay, appreciate it. Lindsay Piegza of Stifel there. Looking ahead to the Federal Reserve a week tomorrow, March 19th, for an update from the FOMC. New forecast as well. Updates coming from the airlines this morning. United Airlines saying it's seeing weakness in travel demand. The headline that crossed just moments ago, a 50% drop in government-related travel. Those stocks initially this morning a whole lot softer, at least in the last 20 minutes or so, recovering, some of which are in positive territory.
Yeah, and some of them have added to some of the cost revenue, like charging for bags that you check, not the ones that you put in the overhead, which might actually lead to a better quality of experience. But there is this sort of question going forward about whether they are the canary in the coal mine in terms of signifying a really rapid sentiment shift where consumers aren't traveling, or is this idiosyncratic? Is it specific to a couple of parade of terribles?
It's an aggressive business, this airline business, eh? United CEO, the Southwest bag fee change is slaying of the sacred cow. Delta came out and said passengers are up for grabs. Pretty aggressive stuff, isn't it? Southwest comes out with a change and they're like, yes, let's go.
First of all,
feels like Hunger Games right now at the airline conference.
If you've ever been lined up to get on a plane, it feels a little bit like Hunger Games too. So just saying, it's not just the airlines that are aggressive, it's also people using the airlines.
Lindsay Rosner of Goldman Sachs joins us now. Not getting into that. Lindsay, welcome to the program. It's good to see you. You don't want to get into that either.
Not aggressive on the airlines, not me. Thank you. No.
Something you said to us last time, I think, that the data is your friend. What's the data telling you now?
The data's telling you right now that you are paid to pause. And what we mean by that is it makes sense to take a page from the Fed's book. There's nothing we have to do in markets right now to reposition necessarily. So for us, we're just waiting to see how the data unfolds. We need to learn more. JOLTS is not going to give us much information, unfortunately, today because it's really January. But we need to see that, back to your prior guess, has the consumer changed their path? We think not, but all of this data is really going to help us.
This sounds so calm. I mean, I love this. You know, people are talking about slaying of the sacred cow and a parade of horribles. And you're saying we can just stay calm and take a look at what's going on and we don't have to change anything. What are you waiting for? I mean, there's a lot of pretty heated rhetoric out there.
Yeah, I think what we're waiting for is prices that make sense. And so we've been saying that fixed income makes sense in a portfolio. If you look year to date, I think there's a lot of concern right now about what's happened with stocks, off 8% from the peak, down maybe 4% overall. This isn't a massive move, but contrast that, which we think is really important, with what fixed income's done for you. It's earned you in the front end of the curve 2%, in the middle of the curve 4%, back end even more. So I think we're calm because we're bond people, but we're calm because we have a good setup in our portfolio construction overall, with bonds as a ballast.
There's a question about how long-term bonds can really remain a ballast if people start to get concerned about higher overall inflation from a deglobalized world, the idea that supply chains will have more built-in inefficiency. How do you cope with those kinds of discussions? Do you just assume that there isn't going to be price appreciation, that yields are going to sort of stay around here and that that's fine because it's relatively good to be paid to wait?
Well, what will be a problem certainly would be if tariffs are on the maximalist side of things. And what we've seen recently is tariffs on, tariffs off, tariffs being placed out there at a higher level, then brought on at lower levels. I think until we see a full-blown, really aggressive tariff regime, I think you can feel confident in bonds. They have good coupons. We're starting at a good spot there. They will be support, we think, as we wait to find out more. But again, we don't have to day trade our portfolios. And I think that's the important thing. There's been a lot of just frenetic behavior in the markets right now. We were talking before we got on that it's hard to think about even taking a day off from the markets. You can't take a vacation, I think, right now under this administration. But as we learn more, I think we're going to be emboldened that rates are going to help you.
When you're looking at potentially that maximalist approach to trade, it sounds like you're basically waiting for April 2nd. Is that accurate?
Yeah, we're waiting for April 2nd, just like we waited for March and we waited for February. I mean, I think there's a lot of markers that we keep waiting for. At some point, I think there will be an end to kicking the can a month, and we'll have what is the final here. And that's what really people are waiting for. And I think that uncertainty doesn't do the market well. And so hopefully April 2nd is maybe the beginning of the end of we know what the permanent state will be.
We're seeing some economic advisors outside the administration, but close to the president, like Steve Moore, saying you gotta push up the tax cuts. You can't wait for the end of the year. Do you think that's an accurate assumption, that they need to be able to balance some of this uncertainty and bad rhetoric around tariffs with some of the good policy changes they're trying to get through?
Yeah, I think you're bringing up a great point. If you think about what happened post-election, we had this big euphoria bubble. And I think a lot of people have said that, the air is out of this bubble, or the balloon has burst, so to speak, because all the good stuff was thought about, deregulation, tax cuts. Well, we haven't had those yet because the sequencing takes time. Instead, we've seen the more negative things, potentially, like tariffs. And so it's really hard when everybody was banking on really positive things to happen. The negative ones happen first, and we're still waiting for the positive things later on. They are coming. I think they're coming much, much more slowly. Certainly, if we sped them up, I think people would feel a lot better.
We're getting some policy clarity abroad, and I wonder how you and the team are thinking about the surge we've seen in European bond yields over the past week or so, specifically in Germany, the 40 basis point move last week. These are regime shifts in policy, particularly in Germany, that we haven't seen in decades. How are things changing for you and the team? How do you think about the global backdrop for fixed income now?
Yeah, so what we've said really since 2024 is that there are great opportunities of divergence and that we should be able to take advantage of them in our macro strategies. What's happened in Germany is, to your point, something totally new, large, significant. We actually don't think that the backup in yields is over yet, so we wouldn't hop in yet. Still prefer the U.S., but I think it's really important to think what that means for a backdrop for credit. So from a credit perspective, Europe has actually outperformed the U.S. So when we're thinking about how to position our portfolios, we're still leaning into U.S. because we feel like there's more opportunity there. But should that be dislodged, it'll be a good opportunity to shift the portfolios and add back in European credit once we get more clarity on, in fact, if the defense spending will be passed, what will really happen.
What's more compelling to you, the pushing away from the U.S. effect of a potential deterioration in the data, or a potential positive shift, not only with respect to the spending getting passed, but a sense that maybe it could ignite some kind of growth and infrastructure spending on the heels of it in Europe?
Yeah, so this is the big change, and I think you're seeing that with the yields in Europe. This is big spending, and I think now you're starting to see that all the views that there could, in fact, be a recession in Europe or things are looking really, really weak, that's changed a lot because spending is a huge part of GDP, government spending. So that does change the tone out there. But what's important is it is a global environment, and I think what we've seen with stocks, with bonds so far, and the big volatility in performance is that you want to do active management to take advantage of all of these differences and all these movements because they're happening quickly.
Lindsay, it's good to see you, as always. Appreciate the update. Thank you. Lindsay Rosner at Goldman Sachs. Don't take a day off. No one at Goldman takes a day off, do they?
Certainly not this year.
Vacations at Goldman.
But this is the reason why people aren't going to be traveling to beautiful, warm, sunny spots that are going to be really nice.
Cheaper flights for you, Bramo.
I know, maybe. You're trying to send me away?
No, not at all.
You're like, yeah, you could go get one.
Not at all. I'm coming with you.
Fabulous.
Futures on the
trip.
S&P, just about unchanged. Let's get you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Speaking of airlines, John, United Airlines said that it's seen a 50% drop in government-related travel. Speaking at a JP Morgan conference, the CEO said the company is seeing weakness in travel demand. Reacting to the news that Southwest will be charging for bags, he said it's the, quote, slaying of the sacred cow. 5 of the billionaires at President Donald Trump's inauguration have collectively lost $209 billion since January 20th. The Bloomberg Billionaires Index shows that Elon Musk's wealth has declined by nearly $150 billion as Tesla shares have tanked. Jeff Bezos has lost $29 billion and Sergey Brin has lost $22. President Donald Trump says that he's going to buy a new Tesla this morning. Speaking of the slump in Tesla shares, he said it's a show of confidence and support for Elon Musk. Tesla fell in their worst day in more than 4 years yesterday. In a post on Truth Social, Trump said, "Why should Musk be punished for putting his tremendous skills to work in order to help make America great again?" And that's your brief, John.
Danny, thank you. Thanks for this morning. Appreciate it. Up next on the programme, we'll set you up for the day ahead. We'll head down to Washington, D.C. and catch up with Tyler Kendall, looking ahead to 5 p.m. Eastern Time when the Business Roundtable sits down with the President of the United States. Yesterday, the worst day so far in 2025, down 2.7% on the S&P, on the Nasdaq 100 down by 3.8. Today, no real bounce at all. We're totally unchanged on the S&P. We're not even positive 0.1% now on the Nasdaq. The opening bell, about 38 minutes away. Let's get you the day ahead. It looks like this. 10 a.m. Eastern Time. JOLTS job openings at 5 p.m. The President meeting with top CEOs and Wall Street bank executives. Look out for that, the Business Roundtable later. Wednesday, CPI plus President Trump's tariffs on steel and aluminum go into effect. On Thursday, PPI and another round of jobless claims. On Friday, the U.S. government shutdown deadline. Bloomberg's Tyler Kendall joins us now for more. Tyler, looking forward to later on this afternoon. What are you expecting?
Well, John, President Trump has said that there will be a short-term adjustment period in order to have long-term growth. I'm sure many of these executives would like to know what that timeline is that the White House is tracking here. Interestingly enough, 1 week ago today, the Business Roundtable put out a pretty lengthy statement about President Trump's economic agenda. It was right before he addressed a joint session of Congress. And unsurprisingly, they touted their support for many of his economic policies, including tax cuts and deregulation. But notably, they said that they were going to push President Trump to protect the benefits benefits of the USMCA, citing that U.S., Canada, and Mexico trade has contributed to more than 13 million American jobs. So no doubt tariffs and the uncertainty that comes with them are going to be a topic of discussion today. We should quickly note that this continues a trend from this White House when it comes to outreach to the private sector. Yesterday, President Trump met with some top tech CEOs. I was there at the White House. I watched them walk in, though they didn't answer any of our shouted questions, but it included execs from companies like Intel, IBM, Qualcomm, and HP as their industry in particular tries to navigate these tariff threats. John, the official White House schedule says that President Trump will be at the business roundtable for 1 hour. We know he's prone to long remarks, but we are expecting that after he gives his public-facing comments, he's going to end up having some private conversations with the execs in the room.
Tyler, appreciate it. Looking forward to that. Some of it might be on camera, so look out for that later on this morning, later on this afternoon. Tyler Kendall down in Washington, D.C. Want to watch a little bit later. It's interesting. This morning, we've hardly talked about the tariffs on steel and aluminum, just assuming 25% on steel and aluminum happens overnight.
That's what everyone is expecting. Those tariffs go into place tomorrow, 5 p.m. I want to know if these executives leave the room feeling uncertain. And 10 a.m. when the Tesla showroom in Georgetown opens up, I want to know if Donald Trump really goes and buys one.
I want to know what President Trump could say that could potentially stave off some of the uncertainty in markets and whether he'll even begin to try, especially because it could be seen as a reversal or a capitulation of some of the current stance that he's taking that's hardliner. That's really the key to me.
They've been pretty consistent with the message over the past few weeks. Let's see if it stays that way later on this afternoon. Coming up tomorrow, Alicia Levine of BNY, Adam Hodge of Bully Pulpit International, Rick Wurster of Charles Schwab, David Kelly of JP Morgan. CPI tomorrow morning, the main event, live from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. After early exits in Dubai and Doha, Coco Gauff is looking to play herself back into form, and the former US Open champ enjoyed a confidence-boosting win over last year's finalist Maria Sakkari. The 20-year-old closing it out 6-2 in the second on her 6th match point to reach the round of 16.